It's 9 a.m. here in New York City on this Monday, January 6th. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, stock futures kicking off the week in the green. U.S. equity futures ticking higher as investors await key economic data this week. The December payrolls report is out this Friday, and expectations are for non-farm payroll growth of 160,000 last month. That's down from an above forecast 227,000 in November. Meanwhile, treasuries have been under pressure with the yield on the 30-year bond seeing its biggest jump since November of 2023. Morgan Stanley warning that rising yields are the most important variable to watch as a headwind for stocks in the first half of the year.
Plus, NVIDIA investors looking for the stock's next breakout. CEO Jensen Huang is set to deliver the keynote address tonight at CES in Las Vegas. Investors will focus on any commentary surrounding its Blackwell chip, which is considered to be the company's next major growth driver. Now, despite seeing robust demand, supply constraints from manufacturing challenges have slowed the chip's rollout.
And earnings season kicks off this week. The latest read on the health of corporate America coming from Walgreens and Delta. Delta earnings could get a boost from decreasing fuel costs, which would ease profitability challenges. For Walgreens, the focus will be around the retail pharmacy segment performance and management comments on strategic initiatives. The stock is currently trading at decade lows. A big week ahead for investors with non-farm payrolls and the Fed minutes also due out. Plus, earnings reports kicking off and the NVIDIA CEO speaking in Las Vegas, all amid a shortened trading week. All right, we've got a lot to break down here. Joining us to talk about it all, we've got our very own Josh Schaefer. Josh, okay, so where do we want to begin? Perhaps on some of the economic data that's coming out.
Yeah, we can start on the economic data, Brad. I mean, the other stuff is going to be a little bit earlier in the week, right? So you're going to get CES today, you're going to get Jensen Huang speaking, just kind of a broad question there of if that gives you any sort of boost to the AI trade, boost to NVIDIA, which maybe would be a boost to the market. But I agree, I think the most important thing this week is going to be that Friday, December payrolls report. And really because the key right now, it seems like in markets, has been this rising rates story, right? We have the 10-year now up at 4.6%, above a key threshold at 4.5%, where a lot of strategists would tell you, okay, people are going to start moving into only large cap companies, only quality companies. It kind of hurts your broadening trade. And my question going into Friday's report is, well, what does the market want? Would a weak report help the market because rates come lower, or are we in an environment where you need solid economic data, if not better than expected economic data, because rates are going to be higher for longer, and in that environment, the key to equities would be a good, strong economy, right? So there's sort of two reads there, and I'm not really sure. I've seen both opinions on how the market could read Friday's reports. I think it's going to be a little bit of a wait and see for how that report comes in. But I mean, if your unemployment rate goes up to 4.3%, that's the cycle high, you start to have some sort of questions about, okay, we've been cooling, how cold are we getting? And then on the flip side, do we have inflation concerns if the labor market is just ripping higher and something like average hourly earnings are higher? So I think there'll be multiple ways to read this print, and will be one of the more interesting prints we've maybe had in a little while.
Talk to us a little bit more about that one scenario that you did lay out there, because if we do see a weaker print, maybe initially there would be some hesitation just in terms of what that could signal going forward, if we could then see further weakness heading into 2025. But you cited it in the morning brief this morning, and it was Michael Kantrowitz over at Piper Sandler just laying out the fact that there could actually be a relief rally potentially underway if we do see that. I guess, to what extent are we hearing from strategists that those gains could be seen? Is this something that will likely be short-lived, given the fact that there are obviously still concerns?
I think it depends on what your other economic data is doing as well, too, right? Is it just the labor market's weakening and the other data still remains strong? What do your inflation prints look like for this month? It's all going to come together into one thing. So Kantrowitz offered that scenario, right? He said we probably need weaker economic data, right? But Morgan Stanley's Mike Wilson, who also called out rates as being an issue, said there is still a good news is good news scenario. He said you probably need animal spirits to come with you with that strong economic data if that were to be good. So if rates are going to stay high, but you have a strong labor market still looks good, do confidence measures continue to come up? do we hear from corporates in fourth quarter earnings, which are going to start this week, that they feel okay about higher rates? That's sort of one of the looming questions right now. Is we're getting to a point now where rates have been high for a while. We know how the chart looks when you look at the 10-year and the S&P 500 over the last year. When we get above 4.5, that's when we've seen valuations start to compress, right? That was your April drawdown of last year. That was your drawdown going back to fall of 2023. So it will be interesting to see exactly how that plays out. But there's kind of a multitude of scenarios here where rates could be high and that's okay. Rates could be low and that's okay. I definitely agree, Shauna, with what you're saying, where if rates come low, you're definitely going to start hearing a little bit more, be careful what you ask for.
Yeah.
Because if rates are coming low because of weak economic data, we know that at some point you don't actually want the data to continue to be weak. One bad print might not be a bad thing, but multiple bad prints and you're going to start to have some concerns.
You mentioned the corporates that we're going to start to hear from this week, and it seems like the consensus is lining up around a S&P 500 calendar year growth of earnings growth of 15% a year. So how does this and what we hear from companies, how does this set the tone towards hitting that marker for the markets that have already started to really price in that for the calendar year?
Yeah, Brad, I think it gets to what do companies say about the key questions and concerns that people have been talking about for the last couple of weeks, right? And I'm talking about the Fed maybe not cutting as much. We haven't really heard from companies since that narrative has shifted, right? By the time most of these companies start talking, it will probably be post-inauguration. What are companies saying about tariffs? What are they saying about other Trump policies? How will that shape their earnings? Because if we start to get a clearer picture on what the tariffs actually could be, then corporates can go and assess, okay, if we're getting a 20% tariff, how does that impact my bottom line? We're going to move guidance for 2025, right? So that it's really going to be a big question of what are these companies guiding for not only the first quarter, remember this is fourth quarter of 2024 earnings, but also the entire year and how they're taking in some of these uncertainties and maybe starting to calculate them into their actual earnings. Because remember, earnings estimates usually come down. That 15% is going to come down at some point. How far is it coming down is kind of the key question here, because 15% is pretty good.
All right, Josh, great stuff. Thanks so much. Well, that December jobs report is a key focus for markets this week as investors look for more clarity on the Fed's path forward. Take a look at the pattern that we've seen in the job market here over the last couple of years. You can see the chart up on your screen right now. The job market clearly has been cooling now for quite some time. So what is a signal maybe about what we could expect on Friday and what could be ahead in 2025? For that, we want to bring in Veronica Clark, an economist with Citi. Veronica, it's great to have you back here on the program. So when you take a look at consensus expectations right now, pulling that up on my screen, it looks like at least from Bloomberg estimates at this point, we are looking for average job gains here to be right around 155,000, taking a look at the unemployment rate at 4.2%. How does that compare with your expectations?
Yeah, we're coming in on the softer, more pessimistic side of that. So we think 120,000 payroll jobs added, which is a bit below, below consensus expectations. Clearly a further slowing. But I think the most important part of this Friday's data is that unemployment rate. And there we are also more pessimistic. We think the unemployment rate will rise to 4.4%. We're already very close to rounding to 4.3%. We're essentially back at the highs that we reached a couple months ago. And importantly, that's happened with people dropping out of the labor force, this decline in labor force participation. If you do see people returning, we know that this is a really weak hiring environment. Those people could easily be counted as unemployed.
Where are you seeing that? And in terms of what kind of tier or generation within the workforce, you're seeing the fastest number of dropping out of labor force participation?
Yeah, it's been kind of broad based. I wonder if it's maybe we've had some increase in return to office mandates. Maybe it's remote workers who are choosing to leave jobs. I think all of this is maybe a way that businesses are trying to reduce labor costs. You're not hiring. You're hoping that people quit. You don't have to lay them off yet. But you are still trying to cut labor costs, and that really can still drive the unemployment rate higher. Just a weak hiring environment alone, you should expect a gradual increase in the unemployment rate in that case.
Is there a risk, Veronica, of that unemployment rate heading even higher? And then I guess what does that signal about some of the weakness that we could see when we start to think about some of the ripple effects across the economy?
Right. Yeah, absolutely. I mean, usually in labor market cycles, this is what you see. You see a very gradual increase in the unemployment rate. It's businesses cutting back on hiring, reducing hours. They're not laying anyone off in large numbers yet, but that is the risk. That could be the natural next extension. So there is still that risk, I think, that if we get to that layoff stage, you could see the unemployment rate rising much more sharply. We haven't seen that yet, but I also haven't seen anything to convince me that that is not still a risk that is on the horizon. And if people are losing their jobs, we would expect that they cut back on spending and that we would see softer overall economic data too.
Veronica, I'm gonna go one left field question here before we get to the nitty gritty back to it here. But is 2025 the year where we finally see artificial intelligence show up as part of the productivity number in some of these employment reports?
Yeah, I do wonder. It might still, I think, be a bit early. If this is a question I think we've gotten for about a year or so now, and you do see obviously some strong productivity numbers, but I do think it's more still to do with maybe some measurement issues. You are coming off of a very weird period for economic data, during the pandemic. I think it would probably still take a bit longer to really see AI impacting productivity in a larger sense.
Veronica, how are you looking at it? I think it's safe to say, just in terms of the economists that we've had on the show, even the strategists here, talking about U.S. exceptionalism and what we could expect heading into 2025. And very much it seems like consensus is still that the U.S. is by far the leader within that space, just given the fact that you're a little bit more bearish or a little bit more, you see further cooling maybe than what consensus is on the street right now when it comes to the U.S. economy. Is that your view? Or I guess, how does the U.S. then stack up to some of those throughout the world?
Yeah, I would worry that there is a limit to this U.S. exceptionalism story. I think the way that I see the last couple years, at a high level is just that, rates are restrictive. We have had, substantial fiscal support for the economy. Of course, that was during the pandemic and immediately post-pandemic, but also things like the infrastructure, CHIPS Act, all of that was direct spending that was going out into the economy. And rates are still restrictive, but that support from fiscal is fading. And I do think that's true for 2025. And if that support is going away and rates are still restrictive, the labor market is still cooling, you are still setting up for those weaker growth outcomes.
What's this all mean for the Fed, Veronica?
We think the Fed is cutting much more than the market is currently pricing. We have 125 basis points total for the Fed this year. I think we're pricing a little less than 2 cuts, less than 50 basis points right now.
Veronica, thanks so much for taking the time here. Really appreciate it this morning. Happy New Year to you.
Happy New Year.
NVIDIA CEO Jensen Huang will deliver the keynote address kicking off this year's Consumer Electronics Conference this year here, CES, the tech conference as you know it. Wall Street has high hopes for Monday's speech as investors are looking for new commentary around AI that could push NVIDIA and the broader markets to new highs here. And of course, there's going to be a lot of focus on this specific keynote. There are going to be some other keynote speeches, and we don't want to take anything from those speakers, but Jensen Huang really going to be taking the cake here. And if there are 3 things that I kind of summarize this to in my mind going into it, it's partnerships, it's product, and excuse me for any redundancies, but productivity as well. And I think about the partnerships that they could come on stage and really lean into and talk about some of the other major corporates that they're looking to work even further with to entrench their own market position. And then on product, it's going to come back to Blackwell and what they say about that GPU, because that is also another form of entrenchment that they're looking to make sure in some of the purchase orders that they're receiving that they're able to deliver on that backlog. And then just lastly here, the productivity. We were just talking about it from an economics perspective here, but as we've been discussing for the better part of a year and a half, this 4th industrial revolution, NVIDIA, essentially the poster child of AI at this juncture, going into that really hitting critical mass. And what do they have to say about where we are in that larger cycle here? Everyone says it's still early innings, but if this is the type of revenue or at least profit base that we can expect from NVIDIA in early innings, then how do they continue to show and really compound upon some of the growth that they've already exhibited to Wall Street?
Yeah, and I think the big question going into this, remember Yahoo Finance's product of the year was the Blackwell chip, and a lot of that is just surrounding the chatter that we've seen over the last several months, the expectations there. We have seen any sort of positive hints that we've gotten from Huang in the past has been able to alleviate some of the fears out there on the street just in terms of potential delays and the impact that is going to have on NVIDIA going forward. So I think any sort of bullish commentary surrounding that specifically obviously has the potential and likelihood here to reignite some of that excitement that has been lost within the stock, because Brad Brad, like you said, when you take a look at the share price reaction ever since we got that last earnings report towards the end of November, right around November 20th, I believe we haven't really seen NVIDIA stock do too much. It's essentially flat since their last earnings report. So again, a lot of that is because of the concerns surrounding the Blackwell chip. So anything that we get from Jensen Huang here tonight, just regarding some of that strength, regarding the strong demand that he has repetitively has said the last couple of times that he's spoken about it, I think that really has the ability here to further put some of those fears to rest and reignite some of that lost confidence that the market seems to be suffering from now.
Yeah. It's been a lot of runs to the upside.
There has.
No problem
yeah, what was it up? 150%, something like that over the past year? Exactly. All right, well, we have much more coming up on a morning brief. But before we head to break, let's get a quick check on the Canadian dollar on reports that Prime Minister Justin Trudeau will resign this week. You're looking at a drop here just about 1% versus the dollar. Now, stay with us. You're watching Morning Brief.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we're tracking some chip makers rallying after NVIDIA's partner Hon Hai reported faster than expected revenue growth, boosted by demand for AI hardware supply. The Taiwanese company is also the world's largest maker of iPhones here, and you're seeing some of the chip makers here, NVIDIA, AMD, and Taiwan Semi, all moving higher here pre-market by a few percentage points here, most notably here for Hon Hai and what they had to say. They ultimately saw revenue, $64.6 billion of revenue for the past 3 months. December revenue, that was up 42%. The company also expecting some significant sales growth for the first quarter. Shares for Hon Hai also moved higher in their local trading.
Yeah, I think when you take a look at this, exactly what is driving some of this demand, a lot of that is the hyperscalers. We talked about that time and time again when it comes from some of that demand that we have seen from Google, when it comes from Amazon, just ultimately Microsoft, what that means going forward. The lack of compelling use cases, though, so far for AI has been making investors a bit nervous just about what that expansion will look like down the road. But again, when you take a look at the fact that we did get forecasts for significant sales growth here for the first quarter, that's helping some of that sentiment right now on the street. It's also important to point out Goldman Sachs revising their 2024 earnings estimate by 1% based on that higher than expected December revenue. So again, the street a little bit more optimistic at this point.
Yeah, just for the transcript, I'll say that this is known as Foxconn, more colloquially.
Yes, it is. There you go. Maybe it's more of a household name.
Yeah.
All right, let's take take a look at U.S. Steel and Nippon Steel filing a lawsuit to keep their deal alive, challenging the Biden administration's decision to block the nearly $15 billion acquisition. The lawsuit alleging that it was a political decision and violated the company's due process. You're taking a look at the reaction here in shares of U.S. Steel. Again, when you take a look at it, ultimately what this would mean here for the landscape of steel in the U.S., obviously what that's going to do for future competition, what ultimately this could mean for foreign investment interest here in the U.S. That has been another hotly debated topic here, just about the fallout here from this. But again, the decision here coming from these companies here to try and change ultimately or pressure this decision, obviously will be a wait and see, and we will see how all of this plays out.
Yeah, they're essentially alleging that there was really no good faith in the reviewing of this deal. And they talked about how President Biden ignored the rule of law to gain favor with United States Steel, U.S. Steel, paper, forestry, rubber manufacturing. They go on, but they say and allege and bring forward within this litigation that as a result of President Biden's undue influence to advance his political agenda, the Committee on Foreign Investment in the U.S., CFIUS, failed to conduct a good faith, national security focused regulatory review process, depriving the two entities, Nippon Steel and U.S. Steel, of their rightful opportunity for fair consideration of the transaction. That is alleged by the companies here. They put it out in a press release this morning. Here, shares of U.S. Steel moving higher pre-market by about 4.4%. But still, if you were to kind of broaden this out and look at some of the turmoil that's ensued since the blockage of this deal, and really only several deals have been recommended to the president in history of CFIUS to be blocked. And this just the latest of that, less than 10 deals in the history of CFIUS here.
Yeah, and it's also pointing out, maybe some of the viewers at home are asking where Trump stands on this, whether or not he has changed his stance at all. President-elect Trump last month, once again, underscoring his intention to block the deal. He reiterated that in a post on Truth Social here earlier, saying, why would they want to sell U.S. Steel now that tariffs will make it a much more profitable and valuable company? Wouldn't it be nice to have U.S. Steel, once the greatest company in the world, lead the charge towards greatness again? It can all happen very quickly. So again, you see some sort of that consensus there, just in terms of why ultimately maybe this deal would not make sense from both sides of the aisle.
Yeah, absolutely. Also here, we're going to go to the skies for a hot second here. Let's feel happy in the air. Delta Airlines is set to report fourth quarter earnings this week. Joining us now, we've got George Ferguson, Bloomberg Intelligence Senior Aerospace Defense and Airlines Industry Analyst. George, always a pleasure to grab some time with you. What are you expecting to see from Delta?
Yeah, so I think what we'll watch very closely is going to be Delta's yield. So we're expecting that the yields or price paid per mile flown, we think of it very synonymous with fares. We think they will continue to edge over. So we've seen declines, small declines in what consumers are willing to pay to fly. But the saving grace for Delta in 4Q will be fuel prices are down dramatically. We think that'll add, 400 basis points or so to their margins. So that's going to be, I think, the bright spot in the market. But again, a big portion of what we're going to watch at Delta is how demand is holding up, how fares are holding up. They're going to grow capacity 4% during the quarter. So we still see capacity growth above GDP rates, which we think typically means softer fares. So we'll see with that higher growth rate, if in fact the consumer is maybe getting a better deal. It's getting a little softer out there.
So George, did you say it could be getting a little bit softer out there?
I think so. Yeah, we think so.
Yeah, I guess to what degree? And when we talk about the pressure that could ultimately then put on these airlines looking ahead to 2025, we talked a lot about some of the strengthening fundamentals. Does that offset maybe some of that looking ahead to the next year?
Yeah, so as we look into the new year, as we left 2024, fuel prices were down. We kind of look at Gulf Coast jet down around $2 a gallon. They're back up a little bit from there, but we're still in the first half of the year going to see a really strong tailwind from fuel. So fuel will allow the airlines to discount a bit to fill airplanes. And so that could mean first half looks as good as last year. I have a hard time imagining it being better. It still feels like demand is a bit soft. We've seen the pain in the low-cost carriers, right? We've seen the challenges at Southwest, the challenges at JetBlue, Spirit declared bankruptcy. Capacity looks like it has to come out of this marketplace. As we look at the first half of 2025, we see more capacity coming from the big full-service carriers, Delta, United, American. We think that means that premium seating is probably moving into the slightly oversupplied, area, which means their source of strength may not be as strong in the first half. So, sort of, if I wrap that whole thing up, profitability is probably still good, about what it was a year ago. But again, I think we see a little bit of softening in maybe that premium demand for the big full service carriers, and maybe a little bit of improving for the low cost as some of that capacity comes out, as Spirit cuts back capacity, Southwest and carriers like that.
George, it's really interesting. I mean, especially thinking about Delta CEO Ed Bastian going to be starting off his week on a more fun note at CES, and then making his way back, ending the week all business, of course, here for Bastian as we get these earnings that are going to be coming out. But as you mentioned premium, it really kind of lit a fire, at least in my mind, around what they were talking about at the Investor Day, and really leaning into what could be a new tier of premium. What do you imagine that needs to look like in order for them to stave off any of the pressures on pricing that we could see the industry face this year?
Yeah, so I mean, a new tier premium, I guess it's I always sort of struggle to figure out what else you're going to bring to the front of the airplane to make people want to pay up. Look, I think that business travel is about where it was in 2019, so it's lagged a bit. What could work for Ed Bastian could be continued return in business travel, which could boost some of his front of airplane revenue. Look, I think Delta probably gets as good as it gets when it comes to premium travel, with their lounges, with their reputation in the marketplace, with the product they're offering in the front of the airplane. A lot of people are trying to bring premium, airlines like Frontier, by cutting out middle seats. That isn't that premium to me. And so I think he's still sort of maybe the market leader in premium. How he brings more to that, I don't know. I guess he makes you feel more special as you get on the airplane or something like that.
Maybe it's a Lenny Kravitz concert. I don't know. That's what they're doing at CES.
They do. They play games like that, offering good customers different kinds of perks like that that are probably off airplane.
I'm not good enough, George.
I was going to say, did enough to win Brad over. All right, George, great stuff. Thanks so much.
Thank you. I appreciate it. Yeah.
We've got much more of your market action ahead, counting down to the opening bell on Wall Street. That's just 3 minutes away. We'll be right back.
We're just seconds away from the opening bell here and taking a look at the U.S. major averages. The futures right now pointing higher across the board, nearly a percent higher, we'll call it, for the Nasdaq futures. Here are our bell ringers for today. You've got Headspace at the Nasdaq celebrating Wellness Week, and at the New York Stock Exchange, you've got JBT Morel ringing the opening bell. All right, taking a look at the major averages as we kick off this trading week. The first full trading week, well, not exactly. We were close. We're going to have, of course, the National Day of Mourning in observance of former President, U.S. President Jimmy Carter here. As we're taking a look here at the major averages to kick off today's trading week, we've got the Dow Jones Industrial Average right now higher by about 0.3%. The Nasdaq Composite, you're seeing that move higher by a little more than 1% to begin today's activity. And the S&P 500, you're seeing that up by about 0.7% here. I see those candlesticks. I see that 3-month view. I imagine that our own Jared Blickery has that fired up, so I'll wait for him to get to that. But first, let's take a look at some of the sector activity here before we get over to Jared. We're taking a look at technology, leading the pack right now, blinding me with science. We're up by about 1% right now. And then additionally, taking a look at the laggard, you've got real estate pulling up the caboose here. That's down by about 0.6%. Utilities and, of course, staples as well. And additionally, you're seeing healthcare also in the red. But more gainers than laggards. That's good news to start off today's trading activity. And then just lastly here, I'll take a look and ride out with a brief gander at the Nasdaq 100 here. You can see some of your mega cap tech stocks to begin this week here. NVIDIA ahead of CEO Jensen Huang's keynote address. You're seeing those shares begin the day higher by about 2.7%. That event set to come later on in Las Vegas, Nevada. All right, here in New York City, let's get on over to Yahoo Finance's Jared Blickery for a look at what's moving.
Thank you, Brad. You called it. I'm going to look at a longer-term view of the S&P 500 because we've got some interesting thing going on with the chart right here. This is a 3-month view, and a lot of people were looking for what's called a head and shoulders top here, and we didn't quite get it. In fact, we punched down beneath this support level, and we pop right back above, and now we are heading higher, and so that is not a top at all. And a lot of people like to call these things in advance, but this is one particular pattern that just gets called wrongly all the time. And I also saw this on Bitcoin. I also saw it on some other tech charts. So this is something that's happening here. And what's actually happening is we have what's a W bottom here. We just cleared the neckline and we are off to the races. So that is a bullish pattern that has developed. Also want to point to small caps. Russell 2000 is leading early. That's up 1.72%. It has not cleared its hurdle to make this a double bottom just yet, but it's on its way. And then we want to take a look at the U.S. dollar. Both the 10-year yield, actually 10-year yield is up 4 days, but, and this is something that's really interesting, usually the yields and the U.S. dollar are moving in the same direction, not today. So the 10-year is way up here by recent highs. The dollar has come down appreciably. And in fact, this is the biggest drop since August. That's notable because it's kind of a release valve for risk assets. When it's heading higher into multi-year territory, that just kind of weighs on stocks and other risk assets. So early on, we had energy leading before, but guess what? Tech has taken the mantle here. Tech up 1.23%. Should mention energy too is up because WTI crude is in the midst of a 6-day rally, which is pretty notable. And then I want to go over to the Nasdaq 100 and show you, there's a lot of green on the screen today. I want to show you what's happening with the year-to-date price action. We have NVIDIA leading the Mag 7 pack. I'll show you a year-to-date chart real quick. Well, up 11.07%. I think investors will take that. And got to leave you with Bitcoin because Bitcoin is trying to break through the $100,000 price level once again. It's done that a few times, but it's kind of stuck around 90,000 or 99,000. Here's the 1-year view. You can see actually just below 99,000 right now, but pretty close to those all-time highs. Guys?
All right, Jared, thanks so much. Let's get to today's strategy session. Santa Claus skipping his visit to Wall Street at the end of last year, beginning of this year. But our next guest still saying that several factors can lead to a market rally in the months to come. Joining us now to break it all down, we want to bring in Zachary Hill. He's Horizon Investments Head of Portfolio Strategy. Zachary, it's great to have you here on Yahoo Finance. So talk to me about some of those factors. Why aren't you concerned about that lack of a so-called Santa Claus rally? Why that maybe isn't signaling something a bit more bearish for the months ahead?
Yeah, well, great to be with you and Happy New Year. Santa Claus rally is one of those things that it's a statistical anomaly. It appears in the data, but if you really look at it, it doesn't tell us anything conclusive about the following year. We've had 2 really strong years for the S&P back to back, so that probably means that this year is going to be a little bit more tempered in terms of its overall returns, and we're really looking for earnings growth to be the major driver as opposed to the multiple expansion that we've seen over the last few years as the Fed has taken their foot off the gas a little bit. So we continue to see strength in the underlying economy, and we do think that feeds through to earnings and to stock prices, just maybe not as much as they have over the last 2 years.
Okay, so all that considered, as you're looking at these 3 drivers for markets in 2025, what needs to take place to make sure that these all come to fruition?
Sure. Well, earnings growth, we're going to get some updates very soon, starting next Wednesday, I believe, with the big banks. So we'll be paying quite a lot of attention to, just obviously the fourth quarter, but also, full year guidance for 2025. On the Fed side of things, we have seen a little bit of a shift in terms of the market's overall thought process for how they're weighing growth and inflation. That hasn't been terribly helpful, to interest rates or to equity valuations. So we are a little bit lower, on the S&P and small caps, even lower than where we were before the Fed cut rates in the middle of December. But really abstracting from all of that, our most important view around what we think about Fed policy is they're still talking about cutting interest rates, and they're not talking about raising rates. And so that's going to continue to be something we can argue about if it's going to be 2 cuts or 4 cuts or what have you. But really the bigger picture and the more important one for investors, we think, is the fact that we are going to get cuts this year. And then the last thing would be, the labor market. We get an update on non-farm payrolls on Friday. That's really important for continuing to fuel consumer spending, especially with interest rates as high as they are. Debt is expensive, and so people are spending out of incomes. They need to have jobs to have incomes, and so that's something that we're going to be watching quite closely.
Zachary, when you take a look at the fact that the 10-year yield, right around 462, I guess at what point is that a challenge for some of those earnings growth expectations that we do have going ahead to 2025? And do we need to have a bit of a readjustment here in terms of lower rates here for yields in order to achieve some of those earnings growth expectations?
Yeah, we definitely have seen a pretty sharp repricing in yields over the last month, and I think that's been reflected in terms of the way the market is traded. December was not a great month for the S&P, down marginally, but things like small caps have completely unwound their so-called Trump bump from the election period. We're right around those same levels as we were before the election in early November, and so we do think a lot of that move higher in rates has already been reflected in price action, which means for us, and a continued bullish view of the underlying economy, means that it sets up really well for those parts of the market in 2025.
What about some of your wild cards that perhaps you're keeping an eye on going into this year and amidst the early innings of this year?
Yeah, a couple wild cards. One, is around the level of interest rates. We're not at that level where it really starts to hurt, the underlying economy, but we don't believe that rates don't matter. They will eventually start to bite on underlying economic activity. The reason they haven't thus far is that consumer balance sheets are just really, really strong, and that's a function of all of the things that we did during COVID, the appreciation in home prices, the appreciation in stock prices, all of those types of things wrapped up together means consumers have been more resilient to interest rates. Companies also have termed out their debt, which means they're more resilient to interest rates, and so that's something that has been a feature of the last 2 years and has really confounded a lot of forecasters. We are not extrapolating that necessarily for the next 2 years, though. Eventually, higher interest rates will start to bite on economic activity, and so that's something that we're going to be watching for as a wild card in 2025. And another one too is just potential volatility from the new administration, and we saw some of that this morning with a unsourced article in the Washington Post, and then a tweet refuting that around tariff policy. The way that we're thinking about, the incoming administration, there are some, policy procedures that are really positive for markets and some that are not so positive. And so as investors, we're going to have to continually weigh the positive and negative as the news flow evolves over the coming year. And so that's another thing that we're going to be paying a lot of attention to.
Zach, really great insights. Thanks so much for kicking off today's trading activity with us. Appreciate it.
Thank you. Happy New Year.
Happy New Year. It's time now for our chart of the day. Let's send it on over to Catalyst's co-host Madison Mills for a look at the S&P 500's CAPE ratio. All right, what do you got?
All right, well, we're taking a look at the S&P 500 CAPE ratio. This comes from Deutsche Bank in their 2025 outlook. And you can see here, it is a bit elevated compared with historic levels. But take a look at the dot-com bubble and heading into the early 2000s here. You can see this ratio was elevated for 2 years heading into that dot-com bubble. So kind of throwing cold water on this idea that we are in a very similar moment to those early 2000s, right? Because not only did we have 2 years of this ratio being elevated, but Deutsche Bank argues that this kind of tech bubble here in the early thousands was only popped by a macroeconomic downturn, and they don't necessarily see that coming in for 2025. They also note that if we do see that for 2025, the Federal Reserve has plenty of room to cut interest rates, so that could be a cushion for the economy. They also talk about growth estimates being revised higher for those mega cap, large cap names that are driving a lot of the expense debate in this market over whether valuations are too high. And those growth estimates rising a little bit could again be a sign that, yes, we may see this ratio continue to be elevated, but not so much as we saw in the early 2000s. So again, throwing cold water on that idea that we are in a tech bubble again, and also noting that they are overall cautiously optimistic as we head into 2025, guys.
All right, Maddie, thanks. Coming up, we are taking a look at why 2025 might be an inflection point for GLP-1 weight loss drugs. We got more on that next.
Walgreens was the worst performing stock on the S&P 500 in 2024, down over 60% in the past year. The company now gearing up to report earnings this week. Yahoo Finance's own Anjali Kamlani joins us now. Anj, what should we expect from this report?
Well, as you mentioned, it didn't have a great year last year, and it looks to continue that trend this year because Walgreens is just like any other pharmacy struggling with balancing prescription volume as well as front of store sales. That is expected to remain soft for the fiscal quarters ending on which they'll report on Friday. We do know that, of course, the company is still in talks with Sycamore Partners. That take private potential deal is still on the table, but we're unlikely to get updates on that. That's according to JPM's Lisa Gill. There are some questions still about how well that prescription volume did perform and whether or not they're there going to be any updates on VillageMD performance? That's another area to keep an eye on. So all of these are part of, what, as you see on your screen, the major points that folks have in mind as we're leading up to these earnings. Remember that the pharmacy market has been pretty soft in general. Rite Aid went through bankruptcy and then went private. Walgreens competing with CVS for a very long time, but has pulled away from the healthcare forward strategy, including a focus on VillageMD. They've already been shutting down locations and looking to do more of that and pulling away from that health services sector. So that's another area to listen to on the call and see just what the plans are for the upcoming year.
All right, we will do that. All right, Anj, thanks so much. Let's talk about GLP-1s here in 2025. Certainly was a massive driver for the pharmaceutical sector here over the last several months. But looking ahead to 2025, our next guest calling the year an inflection point for GLP-1 drugs. Joining us now, we want to bring in Emily Field, Barclays Head of European Pharmaceuticals Research. Emily, it's great to have you here. So you're calling it a potential inflection point. What is the biggest catalyst that you see when you talk about the fact that we could be reaching an inflection point? What does that growth then look like?
Yeah, thanks for having me. So really, in terms of the inflection point for the market, both Novo Nordisk and Eli Lilly have clinical catalysts that are scheduled throughout the year. But really, I think what is going to be important in terms of driving revenue upside and the impact of, sector-wide is just the prescription data. Both, Zepbound, Mounjaro, Ozempic, Wegovy have been a supply-constrained situation for a number of years now, and both companies have been investing billions in capacity expansion, such that we think that we're probably going to really start to see the benefits of that here in 2025.
Okay, and so as we're thinking about what this on a revenue basis could look like going forward, how much more growth are you anticipating there?
I mean, it's double-digit revenue growth for the foreseeable future. And what is particularly unique about this market is that, with most pharma products, it's the party's going on until you get to the end of the patent. But with this, the volumes are going to be so big. They're injectable products that are hard to make, such that no generic company is really going to be able to supply the market once they go off patent. So we think that these products are going to have a longer tail relative to a typical pharmaceutical product.
Emily, when you take a look at the political and policy environment right now in the U.S., the incoming Trump administration, is it an overhang for the industry? And I guess how big of an overhang?
Oh, absolutely. I mean, it's an overhang not only for the GLP-1 companies, but for the entire space, just because, at first after the election, we saw a rotation into other sectors that, were very clearly more to benefit from the policies of the Trump administration. Now, particularly with GLP-1s, it's a little bit of a wild card. We have Elon Musk, who's a big fan of them, RFK Jr., who's not a big fan of them, and sort of who's going to win the day from a policy perspective remains very uncertain. So it is an overhang, but we think that, at the end of the day, these are products that people really, really want. And generally, people don't want a pharma product. You're taking it because you need it. This, people want it.
Emily, there's been a lot of focus around the movement towards pills specifically versus injectables. What type of delta is that anticipated to bring here, especially with some of the headwinds that you were just laying out and all of the players right now that already have their product in market?
Yeah, so that's a great question, because not only has this been sort of, a gold rush to get into this market, but sort of the gold rush for an oral as well that theoretically would be much easier to manufacture and would lower the barriers to entry for patients who may be afraid of an injectable. We're going to get the first insights into that in the back half of this year with the phase 3 data for Lilly's next generation pill. That said, we don't think the pills are going to be anywhere near as good as the injectables, and that it will remain primarily an injectable market. And, Eli Lilly itself is still investing billions in injectable manufacturing capacity, even though they do have this pill waiting in the wings. So that we think that tells you something.
Emily, not nearly as good. I guess how then maybe better, can you tell us better specifically, do you think it's going to stack up to the injectables?
Oh, for example, Novo Nordisk now, they did disappoint the market with their data in late December, but they delivered about 23% weight loss was sort of their, for lack of a better word, Ozempic 2.0. We don't think that the pills are going to be able to get as good as Ozempic 1.0 for a very, very long time to come.
Emily, I remember coming out of the pandemic that it was the messenger RNA platform that was supposed to be the next big breakthrough in biotechnology and make its way into producing all of these new solutions to make it to market. And I'm not saying that that's not the case, but we got GLP-1s instead, that was the hot new topic. And so I wonder, now as you're looking across the landscape and seeing some of the patent roll-off that is anticipated over these next kind of year, 18 months here, what is brewing as the next GLP-1 moment for biotechnology more broadly?
That's a great question. And so, when people talk about these, holy grails of pharma, they tend to look at the biggest number of potential patients. Obesity is obviously one of them. The other one is Alzheimer's disease. There are some recently approved Alzheimer's disease therapies for the first time, in a generation that appear to have an effect on the disease. But one thing that's a very, very strange coincidence, and we'll see how this plays out in the second half of this year. Novo Nordisk actually has a trial called Evoke where they're testing semaglutide in Alzheimer's disease. So, maybe that works, maybe it doesn't. But in terms of what would be the next potential, game-changing event would be something for Alzheimer's disease. But what that is, we don't know yet.
Emily, what are your top picks within the sector?
Yeah, so we still like Novo Nordisk. We do view the current levels as a buying opportunity because, CagriSema, the Ozempic 2.0, 23% weight loss, still a game changer. They just disappointed investors with the 25% bar that they'd set. However, it's still going to be a fantastic drug, way better than semaglutide on its own. Another story that we like a lot is AstraZeneca. They had some setbacks in 2024, particularly relative to an investigation into some commercial practices in China. We think they're going to get through that and that they're going to remain the leading global company in terms of cancer care.
Emily, great to grab some time with you here today. Thanks so much. Appreciate it.
Thank you.
Certainly. All your markets action ahead. Stay tuned. You're watching The Morning Brief. We're taking a closer look at some of today's top analyst calls this morning, and we're doing it in 30 seconds each. Let's go. First up, Salesforce, ticker symbol CRM, cut to sell from neutral at Guggenheim. The analyst says that the stock's recent AI-fueled 30% rally is not justified because it's likely to have trouble making money from its AI product, Agentforce, and the company hasn't shown much innovation in a while. The analyst writes, quote, its days of double-digit organic growth are behind it. On the other hand, the same team of analysts upgrading Workday to neutral from sell, writing that while there likely won't be big changes in business fundamentals this year, growth expectations are now properly set up for the future.
Plus, JP Morgan staying underweight on Tesla, citing the company's missed delivery figures for the fourth quarter, raising some concerns about earnings for the year ahead, now slowing vehicle deliveries and the possible removal of government subsidies under a Trump presidency are risks to earnings, as according to the analysts there at JP Morgan.
Finally, American Air getting 3 upgrades to buy this morning from Jefferies, TD Cowen, and Melius Jefferies, they had boosted their price target to $20, citing lower capacity and CapEx spending, as well as a new credit card deal. TD Cowen lifted its target to $25, referencing some tailwinds for the company, including better domestic pricing and regaining business traffic. And Melius raised its target to $23, saying that the airline is appealing at current levels with above industry unit revenue growth.
That does it for the morning brief. Before we head to break, we want to take a look at the Canadian dollar. On reports that Prime Minister Justin Trudeau will be resigning. Taking a look at the move here, when you have the US dollar versus the Canadian dollar, have been off over 1%. We were looking at the biggest drop that we've seen, I believe, in quite some time since May of 2023. But when you take a look at the Canadian dollar specifically, that hitting a session high following reports that Trudeau was going to resign. We're expecting an official announcement later on this morning. Again, a story we will continue to watch. But again, the movement, you're looking at US dollar versus Canadian dollar right there on your screen. We'll be right back. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We're 30 minutes into the U.S. trading day. Let's get you the 3 catalysts that we're watching this hour.
First up, we break down the market outlook for 2025 and what early investor sentiment signals for the months ahead.
Plus, we hone in on Trump's tariff policies as the president doubles down on his plans for his presidency.
And President Biden indefinitely blocking offshore oil and gas development. We'll break down the implications for the industry and investors ahead on Catalysts.
Let's take a look at some of the market headlines to start the hour, sponsored by Tasty Trade. Look at all 3 of the major averages. We are seeing gains across the board. You can see the Nasdaq leading the way up just about 1.5%. You've got the S&P up just around that 6,000 level there, up about 1%. You've got the Dow up 230. Taking a look at the bond market, lots of talk about the move higher that we've seen in yields, what kind of pressure that could add to equities going forward. But when you take a look at the 10-year yield here this morning, is still pointing to the upside here, right around 462. Flipping over to Bitcoin, also catching a bit of a bid here, right above $100,000 level, back above that level that we have been critically watching here over the last several weeks. You can see the rise of just about 3,000 here this morning. And finally, talking about some of the leadership that we are seeing within the market here this morning, we're seeing some of that confidence return to the tech sector, a group of names that hadn't been feeling so much of the love here as of late, but you are looking at some buying across the screen. One of the biggest gainers here in today's action, one of the drivers that we're seeing of the broader market, is NVIDIA. This coming ahead of CEO Jensen Huang's keynote address tonight at CES. Lots of focus on what we're going to hear about Blackwell chip demand and maybe what that could signal, whether or not it could spark not only a rally in NVIDIA stock, but something more broadly speaking that we could see across the market. You're also looking at gains from Microsoft and Google. Once again, today you're looking at Microsoft up nearly 2%, and that's the case for Google as well.
As stocks look to hold on to gains, today's action mirrors a familiar pattern. It's driven by tech stocks. Our next guest sees market breadth flashing a warning signal for the S&P 500. For more, we bring in Joe Mazzola. Joe, great to speak with you. You're the, of course, head of trading and derivatives at Charles Schwab. Just want to get your sense here. We keep worrying about breadth, but the tech rally continues. Does the breadth zombie matter so much if tech can keep this rally going?
You know, I think it matters in earnings season, and here's why I say that, because look at the strength of the dollar that we've seen just really from October through where we're at right now. We've seen about a 7% rally, kind of not given some of the weakness today, but you know that could affect some of the tech earnings. You know, you're looking at markets where 50-60% of the revenue for some of these mega cap companies is coming overseas. Could be something that factors into the earnings, and what we would need is we'd need, you know, the rest of the 493 stocks to kind of catch up, and kind of given where analysts' expectations are for next year in terms of about 11 or 12% growth in the S&P 500, you're going to need to see something that's going to pick up that earnings, and it doesn't mean that we can't have another year like 24 where, you know, tech led the way, but it does mean that a broadening would help. And where we're at right now, about 23% of the S&P 500 above the 50-day moving average. It doesn't show that the market's selling off. It just shows that, you know, we're building a base a little bit, and then I think earnings will be the catalyst to either push that higher or you know, have that come down a bit.
Yeah, Joe, that was going to be my exact question. When you talk about what is going to be that catalyst in order to get maybe broader participation, you just mentioned earnings there. What type of growth do we need to see beyond tech in order to convince the market that this rally does still have room to run?
I think it starts with financials. I think those will be really important. And I forecast that the financials will have pretty darn good earnings. I mean, just look at what we've seen in the steepening of the yield curve. I think there's some excitement around deregulation, what that could mean for M&A activity. So if you get favorable reports from the financials, which I said is kind of my expectation, I think that kind of kicks off things a little bit, and that'll start next week. And we'll see kind of how that carries forward. But you know, they're going to be important right away.
If yields are a tailwind for financials, are they also a headwind for the likes of large caps and tech?
They could be, and here's the reason why. Maybe not the Magnificent Seven just because of the cash that they have on hand, but if you're looking at investor dollars, right? I mean, every investor has a choice. Do they want to put it in the equity market? Do they want to put it in the bond market? Do they want to keep it in cash? And where they're getting 4% and higher yields on cash, there is sometimes, especially given the fact that we've had 20% year-over-year growth in 23 and 24, or excess of that. There is a tendency to say, hey, what's going to happen in 2025? Should I park a little bit on the sidelines? What we're hearing specifically from our clients is there's a little bit less bullishness heading into this January than there was at the tail end of the year. Now we're seeing that, and that a lot of that started in November. And what I found was really interesting is we talk about our stacks report, right? That's our Schwab Trading Activity Index. And what we look at is we look at what clients are actually doing in their portfolio. And in November, I thought this was really key. As the market rallied, clients were trimming into that strength. We actually saw the widest gap that we've seen between our stacks and then the S&P 500. That caught up a little bit in December. The markets pulled back, and our activity index actually went up a little bit. So that did kind of cut into that divergence a bit. But what that was telling us is that clients were already kind of starting to do a little bit of a portfolio rebalance at the end of November, heading into December, maybe paring back some of those higher beta names.
Joe, how does that compare historically speaking when we talk about the rebalancing into year end? I would think that is something that's relatively common at the end of the year as investors try to best position their portfolios into the year ahead. I guess what is to glean from that, just in terms of the big takeaway for investors, what that is then signaling about the trends that we could see in the months to come?
Well, if we look last year at this time, it was interesting. Some of the bigger buys that we saw at the end of the month were like a Pfizer or a Microsoft or an Exxon. What we're seeing this time is it's really concentrated within a couple tech names. So ironically, if I look at the sector that was sold the most kind of within our basket of stocks in December, it was IT, and number 2 was communication services. So you would look at that and you would say, that's interesting, kind of given the fact that the stocks that were bought the most were NVIDIA, Tesla, and Palantir. So it's not necessarily that clients are just pulling everything out of tech, but they're just being very selective in what they're buying right now. I think they really looked at that opportunity in December where you saw that pullback. We basically had a correction in NVIDIA, and they looked at that as an opportunity to buy. Now, Palantir didn't have a correction, right? That just continued to go up, but they also used some of that opportunities on Tesla's pullback to buy in there as well too. So it's kind of hard to make a carte blanche statement, but what we are seeing is selective buying, but rotation into maybe some unloved sectors, and these are interesting ones too. Energy, healthcare, those are sectors that we just hadn't really seen much fund flows in all year. We started to see that in December. So that's part of that rotation and that rebalancing that we're talking about.
How much of a risk do you think the incoming administration and potential policies for that administration could be for those trades that you are seeing so much activity on?
Well, I mean, time will tell on that one. I think every day we get a new report, right? Early this morning we got the Washington Post report, and then that was, corrected by President-elect Trump, within an hour or so. So, we'll have to see kind of what the tariff and the trade policies look like. I think, across the board, what we're seeing right now is I think there's still confidence in the market because, what clients are doing is they're weighing and they're trying to figure out what does that mean for profits if you get tax breaks, for the companies. Relative to the tariffs and what that could mean. So, until we know exactly what that policy is, it's really hard to determine what that'll be.
All right, Joe Mazzola, thanks so much for taking the time to join us here this morning. Happy New Year.
You too.
Disney is set to combine its Hulu plus a live TV business with Fubo to form a combined virtual company. Joining us now with the details, it's our very own Alexandra Canal. We certainly are seeing the reaction play out in the stock this morning.
Reaction play on the stock. Fubo shares up over 100% in early trading. If you take a look at Disney shares, they're up a much more modest 1%. But this is a big deal, one of the first major media deal-making moves in 2025. According to a press release, Disney will control 70% of Fubo, and then shareholders of Fubo, they're going to own the remaining 30% of that combined business, which is going to operate under the publicly traded company name. Now, in conjunction with this transaction, Fubo also settled all litigation against Disney, Fox, and Warner Brothers Discovery related to Venue Sports. That was that upcoming joint venture between those three companies at the time last year. Fubo cited that antitrust lawsuit, saying that it was making the marketplace anti-competitive. And Fubo, as a much smaller player, was really struggling to compete against that. So now with this deal, that lawsuit is dropped. Fox and Warner Brothers Discovery shares also are up around 1%. Now, this is going to form one of the largest digital pay TV providers. When you think about the consumer environment right now, when a lot of folks are cutting that cable cord, Fubo offers those live channels over the internet, primarily focuses on sports and news. Hulu Plus Live TV is looked at as a cable replacement service, so very similar to YouTube TV that also has access across sports, news, as well as entertainment. So on an investor call that I just got off of, David Gandler, he is the CEO of Fubo, and he is going to control this new entity. He said that this creates options to potentially have skinnier bundles, maybe more focused, more targeted content offerings for consumers. So again, another option when you think about consumer choice that could be priced differently. So this is something that I think we're going to start to see across the board as these smaller players are looking to compete. They're going to be gobbled up essentially from these bigger giants. And really, I expect a lot more consolidation here to come. But this is sort of the first sign and the first shoe to drop when we think about the consumer and the options that are out there right now.
All right, Allie, we're going to let you get back to reporting on this as the news develops this morning. Thanks so much for bringing it to us. We appreciate it. Coming up, we'll bring you our research roundup. But as we head to break, we do want to give you a special preview of our live coverage from the ground at CES in Las Vegas. This week, we'll have all the tech headlines for you there. Here's a quick preview of what you can expect.
CES, the annual Consumer Electronics Technology Expo, is set to kick off here in Las Vegas on Tuesday, and it's sure to introduce plenty of interesting, attention-grabbing, and downright weird new products. AI, of course, will be the big story this year, but that's not all. Here's what to expect from CES 2025. AI is everywhere at CES 2025. Sure, it's been the talk of the tech industry since ChatGPT debuted in 2022, but this year's show has turned up the hype to a fever pitch. Samsung, for example, is boasting its AI for All event. From headphones and glasses to pool cleaners and robots, AI is set to dominate this year's big event. It wouldn't be CES without a few good chip stories. AMD, Intel, Nvidia, and Qualcomm are all bringing their A game to this year's show. Expect each company to talk up their latest and greatest chip capabilities and dive into how their platforms are going to power the next generation of AI software. This is the Consumer Electronics Show, so don't expect much in the way of announcements related to enterprise servers and AI-specific chips. Still, AI will be a major part of the conversation. How the company's new chips will beat out their competitors' offerings while running AI applications, the types of apps they can offer, how many TOPS or trillions of operations per second they provide. Expect to hear it all. It's hard to imagine CES without some wild new car tech, and 2025 will be no different. This year, we'll hear about how automakers are embedding AI into everything from their vehicles' dashboards to their driving systems. BMW, Mercedes-Benz, Honda, Hyundai, Toyota, and others are set to show off their latest technologies and more. Don't sleep on the non-four-wheel vehicles either. CES is known to feature a variety of flying cars and tricked-out boats. It's bound to be a menagerie of transportation tech. Of course, you can expect plenty of weird gadgets at CES, from AI-powered appliances and high-tech toilets to electric roller skates and more. CES 2025 will have its fair share of highly talked-about devices that will leave you scratching your head wondering, what did I just see? Finally, big tech is bracing for President-elect Donald Trump's proposed tariffs, and exactly how those will impact everything from enterprise to consumer electronics is certain to be top of mind. It's not just tariffs, though. Tech firms across the spectrum are bracing for Trump's second time in the Oval Office, with leaders of several of the Mag 7 companies, including Meta's Mark Zuckerberg and Amazon founder Jeff Bezos, cozying up to the president-elect in an attempt to repair their frayed relationships. It's all sure to make for an interesting dynamic at CES, and an even more interesting year for tech overall.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session. That's what the Yahoo Finance's trending tickers page. First up, let's take a look at chip stocks. Citi staying bullish on the group of names here within the sector. Buy ratings on large cap, small and mid cap names, component makers and consumables. When you take a look within this note here, taking a look at some of those larger cap OEMs, AMAT, one of those names here, saying that they have a balanced 2025 mix. When you take a look at multiple secular drivers, the valuation discount to peers. Many of the questions going into this New Year's, whether or not we have seen an inflection in the chip coverage here, whether or not we will see further gains in some of these larger cap names, also went on to some of those smaller and mid cap names there, laying out some of the bullish cases there just in terms of demand. The fact that he sees them being, the group there sees them being beneficiaries there of the larger component or the larger bullish case surrounding this story. But I think a lot of this seems to be based on valuation, exactly what the extent of growth could potentially look like here over the next 12 months here, Maddie.
It was interesting. They had a lot of names on the list, obviously, but 5 of them were upgrades to buy from neutral. They had the likes of Nova, Vico Instruments, Advanced Energy Industries, Form Factor, and MKS Instruments, which was the highest gainer, at least in the pre-market trade. You can take a look on your screen here. Just the big gains that we are seeing across these names, again, upgraded to buy from neutral from Citi. And the analysts talking about how after a sharp correction, which we did see, there was seasonal weakness, but it was more than that. The amount of weakness that we saw in some of these names due to demand. He says that second half of last year correction means that the risk reward appears skewed to the upside moving forward. For this group of trades, they are closer to historically attractive PE levels, which is exactly the challenge that we've been talking about for a lot of those other names, including the likes of NVIDIA, which is also, just to say, another name that I know you've been talking about a lot this morning, but also surging off the back of that assembly partner Han Hai surging after their earnings as well. So interesting to see that movement. All right, well, we are also watching gold today. Goldman Sachs delaying its forecast of $3,000 for gold to the second quarter of 2026 due to fewer Fed cuts expected this year. Analysts now expecting it to reach $2,910 by the end of 2025. What really stood out to me here, obviously the macro impact of the Federal Reserve, but also I thought back to that November note from Goldman calling for gold to hit a record high under the Trump administration due to the impact of tariffs and the impact of gold buying as an inflation hedge heading into this year. And now seeing the reversal of that call also in tandem with all the tariff news we've gotten this morning, just really interesting to see that they don't necessarily see that anymore.
Yeah, and what's interesting to me is some of those opposing forces that were laid out within this note, and a lot of that driving into what we have seen the price action here as of late. They talked about the fact that lower speculative demand is structurally higher central bank buying effectively have offset each other. Looking ahead here to this year, they do see the price still rising up to $29.10 by the end of this year, and looking ahead, they're now expecting not to reach that $3,000 maybe until mid-2026. But I think you're exactly right here. As we talk about, there's so much uncertainty surrounding the Fed's next moves and what that is going to look like and the degree to which they are cutting. When you come out with so many of these forecasts, especially as an inflation hedge here, you might see a bit of a readjustment here over the next 6 to 12 months as we do get a better idea of obviously what the central bank has decided, where rates are going to land, and what that longer term rate is going to be. Obviously could have a huge impact on a trade like gold.
Yeah, absolutely.
Finally, Constellation Energy awarded a record $1 billion to supply nuclear power to the U.S. government over the next decade. Joining us now, we want to bring in Paul Zimbardo. He is at Jefferies U.S. Power Utilities and Clean Energy Research Managing Director. Lots to get into here, but I think the big focus, and we certainly saw some of that optimism play out in the market last week on the heels of this $1 billion in contracts that was awarded to Constellation. What do you think this is indicative of, or what this tells us about the demand here for the nuclear sector at large, and whether or not we're entering here in this new into a potentially new era?
Yes, no, thank you very much for having me. And I do agree. I think 2025 is going to be a big year for nuclear, both existing nuclear as well as new nuclear. And it comes back to a topic that we've been following closely. It's just the power demand from data centers and AI is accelerating. You saw Microsoft come out with a significant increase of its CapEx expectations just last week. You know, the thirst for electricity is extremely high, and there's very few sources of clean baseload electricity that is carbon free, and that's really just nuclear.
And talk to me just about how much more room to run there is for a name like Constellation, for a name like Vistra, which topped the S&P 500 year to date for 2024. Can investors still get in on these names?
In short, yes. We prefer a Vistra as well as a Talon to TLN as well. And there, the nice thing about them is they came from very low starting points. So yes, Vistra was one of the best performing S&P companies in 2024, but it came from a very low starting point. The market was unsure about the value of some of their gas assets, describing very low terminal values, kind of uncertainty around future gas. So we do think there's a lot more room to run for a lot of these names, especially Vistra and Talon.
What does that look like for a name like Vistra, just given the massive gains that we saw in 2024?
Yes, no, absolutely. Kind of when we look at the blue sky scenarios, what's really untapped still is the natural gas side. So what we've seen, like you mentioned, the Constellation deal with the government for nuclear energy, we still haven't seen deals from Vistra to be announced yet. We still have not seen deals for natural gas assets. The big power plants that they own, they're one of the largest owners of natural gas, where you have the potential to contract directly with a hyperscale customer. So even though it's had a significant run, great performance 2024, good start to 2025, I think there's a lot more potential once you actually have deals announced for Vistra, which we do expect in 2025.
And zooming out a bit, how much of a tailwind do you expect regulation to be under the Trump administration in particular? Because we did see some of that regulatory wrist slapping in 2024, but I like to think a lot about how when he was at the New York Stock Exchange, Trump said he wanted regulatory approval for nuclear sites within a week. Do you anticipate it being that real and bullish and positive for nuclear stocks?
Yeah, a week might be a little hard, but there's a lot of red tape with the Nuclear Regulatory Commission, also for the new nuclear plants, where right now the projections are around mid-2030 before new nuclear can take a big toehold, which again is kind of the advantage of the companies like a Vistra, Talon, Constellation that actually have nuclear for sale today. So things should get better under the Trump administration on permitting, regulatory reform, et cetera. But kind of there's no real options besides the existing nuclear plant if you want to add your data centers in the next 5 to 7 years.
Well, when you take a look at the pricing here of this deal with Constellation Energy and the U.S. government, how does that compare to expectations? And what does that tell us then about maybe pricing of some of these deals that we could see to come to fruition?
Yeah, no, it's an excellent question. It's the number one question that we get asked all the time. So this deal was around $84 a megawatt hour. And to put that in perspective, just normal electricity in the wholesale market is around $40 to $50 a megawatt hour. So a significant premium for that clean energy, as well as kind of a nuclear upgrade, which is adding more nuclear capacity. So investor expectations for a virtual deal were probably around the $80 level. So you saw the significant outperformance that the stock had, as well as Vistra. The question really becomes, what will the hyperscalers be willing to pay? So that's what we're waiting for, the next big hyperscale deal. We saw Microsoft with a 3 Mile Island restart. We saw Talon and Amazon back in March of 2024, but we're waiting to see what the next hyperscale customer is willing to pay.
Yeah, what do you think is more likely, increased CapEx from the names that have already announced those deals, or a different hyperscaler jumping in here?
Really, I think both. So you've had all of the hyperscalers, Microsoft, Google, Amazon, be involved. Meta has a request for proposal for nuclear. So we're really waiting to see Meta step in on the nuclear side. They made some gas announcements. So I think it's really kind of both aspects right now, because the scarcity of power is the real number one constraint when we talk to all of these companies. I think you're going to see all of the players in large size as well.
All right, Paul, we got to leave it there. Thanks so much, as always, for joining us. Appreciate it.
Thank you for having me.
Coming up, as Congress prepares to certify the 2024 presidential election results, we're going deep on Trump's tariff plans. That's next on Catalysts.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
Trump denying a report from the Washington Post saying that the president's aides are planning to pare back his plans for, quote, universal tariffs to specific sectors. You're looking at a post that President-elect Donald Trump posted this morning on Truth Social. Taking a look at the market's reaction to this, you still have yields continuing to move to the upside here. You have the 30-year yield at the highest level that we have seen since November 2023. Flipping over to the currency market, the dollar paring some of its earlier losses here this morning on that update here from President-elect Trump. Here on what to expect from the early days of a second Trump administration, we want to bring in Henrietta Treyz, Veda Partners Director of Economic Policy. And Henrietta, let's start with this back and forth of what we could see here with tariffs and how exactly this is going to play out. And I bring that up in the context of market expectations, even from the moves that we're seeing this morning, the fact that the dollar paring some of its earlier losses on the update that we got from Trump. What does that tell us just about the market's realistic expectations versus maybe what we are hearing and hoping to hear from the Trump administration?
Yeah, I think it's really interesting. The market is obviously signaling that they take Trump's campaign promises very seriously, and they were moved by the tweet, by the Washington Post report this morning that maybe the campaign promises, which were very vague in the first place, were going to be pared back. What I think it really signals is a repeat of what we saw in the first term, which is that there's not a lot of detailed trade knowledge on the street right now, whether that's understanding Section 301 versus 232 versus IEPA versus balance of payments authority. There's just a lot of different components of trade law that can be deployed by the president. And we expect that to happen in January 20th when Trump takes over. So I think this one is going to be most likely deployed via IEPA, which is an immediate authority. We know that Customs and Border Patrol can update tariffs on any item in 12 hours. So the street should be prepared for that. I think if you wanted to step back and say, what's it really going to look like? Think about how much revenue they're going to need for the tax bill. The tax bill is going to require a minimum of $2.5 trillion to offset just the delta between what they already have and the $4.6 trillion cost of a permanent extension. So we need $2 trillion in revenue. Trump says that we're going to get it from tariffs. You should assume the tariffs will be coming on.
Henrietta, that's exactly where I wanted to go with this reconciliation bill. Are any form of tariffs going to be enough to cover the costs?
No, and really importantly, there's not votes in the House or the Senate to impose these tariffs. So when Congress is writing the tax bill, it will not incorporate a tariff. So what that means functionally is that the president will have to impose the tariffs likely well in advance of the tax bill being written to start generating revenue from the tariffs to go and tell Republican members of the House and Senate who may have an issue with massive deficit increases that the tariffs are going to, in fact, offset the cost. So right now, we generate about $74 billion per year on tariffs. We need to fill a $2.5 trillion gap. So the tariff rates need to rise substantially, and that's going to come from the president because, again, the House and Senate do not have the votes to pass tariffs as a part of the tax bill to functionally offset the cost.
Henrietta, then how should we be looking at the path forward? As Republicans are trying to chart this path forward, maybe what is within the realm of possibilities, what is almost a pipe dream at this point, just given the very, very slim margin for error there, just in terms of being able to get enough votes. How do you see that progressing?
I really can't say it strongly enough. I was the tax staffer in the Senate, and I've worked for Joe Crowley when he was in the Ways and Means Committee. Writing a tax bill is so hard. So to think that this is somehow going to happen in the 30, 60, 90-day time frame is unrealistic. The deadline for a tax bill is not until December 31st of 2025. The best case scenario is that Republicans do, in fact, try to tether the debt ceiling to the tax bill. The debt ceiling is going to be due around July, which is the earliest deadline that investors should have for the tax bill to pass. And then, of course, when the tax bill is written, it's going to be an extension of existing tax rates, not further stimulus from here. So all expectations about massive tax cuts, limited tariffs, easy passage of any of this should be pared back.
Yeah, I want to stick on that, Henrietta, because I think it's such an important point, and we heard Speaker Johnson talking about this over the weekend, that he wants it to kind of be a waterfall of legislation at once in April. Should the market be anticipating more of a drip of policy coming from Washington throughout the year?
Well, that's certainly what Senate Majority Leader Thune would like to see. So Thune, who's been in the Senate for 20 years and has a deep well of experience when it comes to how difficult this legislation is, including the 2017 Tax Cuts and Jobs Act and myriad debt ceiling increases and government funding shutdowns, has appreciated that writing a tax bill is very likely to take 7 to 12 months. And so instead, he would prefer to, give the president some victories on some of the issues he campaigned on early on in, the first half of the year. And that's a strategy that will actually deliver to voters, sort of give momentum to the Republican majority. One of the things to keep in mind is that it really helps the party when you're able to register wins. When you get bogged down in the legislative text, it tends to fracture folks. And in March, we have to have another government funding fight. So I think the president-elect has recently tweeted that he's, going back on this one reconciliation bill strategy, and now maybe is open to the two-bill strategy of Senator Thune. And I think that makes a lot of sense, because you could actually get a military, immigration, border, and energy bill passed in the first 90 to 100 days. I think that's entirely conceivable, maybe even by February 14th if they put their back into it. But one of the issues is that then you don't have that border security red meat to carry into the tax bill debate, which is going to be extraordinarily contentious, controversial, massively deficit increasing. And so you really have those slim majorities, as you pointed out, creating havoc already before the president's even sworn in.
So, Henrietta, just taking all this then into consideration, it doesn't sound like the market's optimism then maybe surrounding some of the things that we have seen drive some of those higher gains here since President-elect Trump was elected. It doesn't seem warranted.
No, I mean, this is going to be really difficult and really hard fought. I do expect all of the tax extensions to go through, but it's going to take 12 months, and there's going to be rocky roads in the interim. I think the bond vigilantes are in a really good position to say, this is going to be a $2.5 to maybe even $5 trillion spending year. Whether that's because of the debt ceiling, the government funding bills, increased defense spending, and of course the tax bill. These are all very expensive provisions. So optimism on deficit increases is entirely warranted. Optimism that this is going to be easy is way off the mark. Anybody who's ever worked in Congress should know that the president does not have the authority to write tax legislation. And though Trump can get Speaker Johnson confirmed as Speaker, he's not going to sway the SALT caucus. He's not going to sway the Inflation Reduction Act, clean energy tax credit supporters. 70% of that money goes to red states. Those members are not going to want that money repealed in writing a tax bill.
Henrietta, to start to wrap up our conversation where we started, this reporting from the Washington Post this morning that Trump's tariff policies had shifted a bit, that it was going to be specific imports, but across every country. That led to a bit of bullishness across certain corners of the market. And then, of course, Trump responding, throwing cold water on that reporting. Do you think that there is any truth, not to this reporting, but to the idea that the market is acting as a check on Trump, and that the market reaction in the 30-year yield, for example, could be moving him on when it comes to his agenda on tariffs?
No, I don't think that that's the case. Indeed, I think that the Washington Post reporting probably has a kernel of truth. I think it's unrealistic to anticipate that the president is going to impose 10% or 20% tariffs across every single import from any given country. That's not what we saw during Trump's first term. Now, granted, he has a different U.S. trade representative in Jameson Greer than Bob Lighthizer, but the strategy that is available and the tactics that are available to the USTR are so much more advanced than just a blanket tariff that we should expect it to be on specific alloys, specific critical components, just as we saw in the first term. It's Section 232 national security tariffs across steel and aluminum, not all alloys that are imported into the United States. It's Section 301 tariffs on a critical list of items from China on a tiered basis. 1, 2, which is industrial components, list 3, which is consumer facing, 4A, which is consumer facing as well, and then 4B, which has never gone on, but is everything you buy at like the grocery store and Dollar General, extraordinarily regressive. The trade world is a lot more nuanced than just a blanket tariff. And so it was probably never appropriate for the street to think that there would just be a blanket tariff. I know that Trump said that on the campaign trail, but I think it's because it's easier to explain. The ability of the USTR, the Department of Commerce, to target individual items and change the tariff rates on those items specifically is something that we should expect, and I think is what the Washington Post reflected. Trump, of course, did not like that it appeared to be lenient and came out and retracted that. So I think there's a long way to go. Keep your eye on the prize. We need $1 trillion or more in revenue from tariffs. They are going on. They will be high.
All right, Henrietta, always a great overview. Thank you so much.
Thanks for having me.
We will have all your markets action ahead right here on Yahoo Finance, so keep it here for more. You're watching Catalysts.
Oil prices rising and today after President Biden moving to permanently ban new offshore drilling on over 600 million acres of ocean. Now, this would impact the entire East Coast, the eastern Gulf of Mexico, parts of the West Coast along the shores of Washington, Oregon, and California, as well as portions of Alaska's northern Bering Sea. President Biden saying in a statement, quote, drilling off these coasts could cause irreversible damage to places we hold dear and is unnecessary to meet our nation's energy needs. The American Petroleum Institute issuing a statement after this announcement saying, quote, we urge policymakers to use every tool at their disposal to reverse this politically motivated decision and restore a pro-American energy approach to federal leasing. Joining us now, we want to bring in Scott Shelton. He's an energy specialist at United Cap. And Scott, it's great to have you here on Yahoo Finance. So talk to us just about how those within the insiders within the industry are looking at this. I mean, you take a look at President-elect Trump, the possibility here that he could try and reverse this, what the odds are, and what ultimately this looks like here for the oil and gas industry going forward.
Well, I think, first of all, most of the U.S. production gains that we're seeing are more onshore and less offshore. And certainly offshore is a component of it, but those projects are 6 to 8 years out. So my clients and myself, we're more focused on onshore production, and we don't think it's really going to affect that. Longer term, of course, if this stays intact, it inhibits our ability to grow, but peak demand is not far away with EVs, and there's plenty of spare capacity out of OPEC. So the concern really isn't there.
How likely that it stays intact?
It's a good question. I think if Trump has his way, it won't be intact. The question is, can he make that change? And that's something that we're currently working on to see if that's a possibility, but it's not clear to us.
Yeah, and the case out there has been that it could potentially be harder for President-elect Trump to unwind this going forward. Scott, when you take a look at where we are trading right now for crude, we have been relatively range bound here. As you look ahead to 2025, what do you see? Are there any further catalysts on the horizon that could get us back to some of these levels that we haven't seen for quite some months?
To the upside, I would think the catalyst would come out of Iran and Russia. We have seen a slowing of Russian exports to the extent where some refiners in Asia, like India, are all of a sudden being forced to access cargoes from Asia rather from Russia. It seems like the net effect of the sanctions that Biden put on shipping are starting to have an effect. And certainly the way that Trump talks with regards to Iran and playing tougher is certainly going to be something that we're going to have to watch pretty closely, because Iran supplies a lot of oil to China, I think about 1.3 million barrels a day. So if all of a sudden we can find a way to slow that down, China's going to be forced to go elsewhere, which will have a positive effect on balances.
How do you square that with the drill baby drill of it all, of the incoming administration and Trump's desire to keep energy as cheap as possible? How much does that weigh on your broader outlook for oil?
Well, we don't really think that there is going to be a significant change on the supply side in Iran. I think if anything, maybe it'll be a couple 100,000 barrels a day. With regards to Russia, it's a wait and see, but the amount of exports they've been able to do under these sanctions has been pretty significant, and we continue to think that. And we think that non-OPEC supply is going to be up about 1.5 million barrels a day, and we also think that demand is not going to be over 1 million barrels a day. So regardless of what happens with Russia and Iran, as long as it's within our parameters, we actually think that it's going to be a stock building year all the way through the end of the year, and it's going to accelerate in the spring.
All right, Scott, we got to leave it there. Thanks so much.
Thank you.
President-elect Donald Trump doubled down this morning on universal tariffs, saying on Truth Social, the Washington Post wrongly reported potential plans to target specific sectors. Now, that comes after this morning the Washington Post had reported that tariffs would be universal to every country, but would only impact certain items. We want to get some perspective on this from a former member of Trump's economic team, Joseph Livornia, SMBC Nikko Securities America Managing Director, also former chief economist at the National Economic Council. Great to have you on with us, Joseph. I just want to get your sense, given that you have had these kinds of conversations with the incoming president, do you think there was truth to the Washington Post reporting?
No.
Tell me more.
No, I don't. I mean, the thing isn't because, look, President Trump's been very clear on what he wants to do with tariffs, and he said some minimal level of tariffs, 10 to 20% across the board, and China at 60. Those numbers are obviously can change, but to come out and say that we're not going to be as high as what he'd been saying and it's going to be targeted is definitely putting the cart way in front of the horse. So when I saw that story, I said that didn't make any sense to me, and certainly President Trump admitted as much.
Joe, what do you think of the market's reaction, though? It seemed like the market was a little bit encouraged by what we heard from the Washington Post report.
I mean, it depends what market. I mean, the equity market is still up pretty significantly today because the market's excited about inflation coming down and growth being a lot stronger. The bond market has reacted a bit negatively, but I don't think it's because of the tariff story, but rather just because you've got a lot of Treasury supply coming in the first part of this year. You've had inflation that's been higher than expected. You've gotten the Fed that has been pretty dovish, and that's led the market to add risk premium in the long end. So the reasons why the long end and the Treasury market broadly has sold off, I don't think it's related to tariffs, though.
But Joe, you just said it, the market potentially, in your view, rallying because they think inflation's coming down. That could be a sign that the market was happy that Trump's tariff policies could be more limited because there's concern that those policies would be inflationary.
Yeah, I don't think it's, I know, no, the tariffs to me are not inflationary. The tariffs are part of a comprehensive program that includes increased energy production, as you were highlighting, deregulation, which can increase the supply side of the economy, and of course lower taxes. So that four-pronged approach, so to speak, will get the economy moving, get growth to be faster. And that to me is what the equity market is discounting. The equity market is discounting what should be a very good year for growth in 25, and hopefully concentrated more in the private sector than in the public sector, which, by the way, in the last 7 quarters, the public side of the economy has grown faster than the private sector. which is really unheard of and unnecessary. So if the programs coming in, DOGE, et cetera, can deal with some of this excess government spending, that'll also go a long way to leading to faster or better animal spirits. And I think the equity market certainly is factoring that in as well.
Joe, when you take a look at the bond market and the reaction really that we've seen since that first cut going back to the fall, it's been pretty steady in one direction to the upside here. When you take a look at yields, the current rate right now on the 10-year yield, how much higher could we potentially see? And I guess at what point does that become a bit problematic here for growth?
I mean, right now rates are pretty high. We think they're above where estimates of fair value have them. Unfortunately, the Treasury's decision to shorten the average maturity of the debt does pose some problems in the sense that eventually that debt will need to be termed out. I'd say there is a risk that 10-year yields could move higher, perhaps make a move up to 5%. But if inflation's coming down and we've got very good growth, close to 3%, if not better, we look at the first Trump 1.0, we had low rates and good growth and low inflation. So I don't think rates are sustainably going to be higher here, but it's not to say in the short term we can't get a move up. I also think a lot will depend too on what the Fed does. I mean, the reason why the market is sold off is if you look at the term premium after that 50 basis point cut back in September has explained the bulk of the sell-off in 10-year yields. And the fact that Fed imprudently cut in November and December is a reason why these yields have risen, why the yield curve has steepened. The Fed cut when it shouldn't have.
Really quickly, want to get your take on this reconciliation bill. Speaker Johnson saying that it could be passed by April. When do you think the market should anticipate getting policy clarity from the incoming administration? Should it be in April?
Well, President Trump said he wants something on his desk in May, and that'd be right around 100 days from when he took office. So I think that's very doable. And I like the fact that there's going to be one big bill. I think that makes a lot of sense as opposed to breaking it up. So I'm optimistic that we can get it done, whether it's April, great, or May. I mean, that really won't matter.
What happens if it's two bills, though, Joe?
Well, right now, President Trump has said he wants one bill.
Yeah.
And Jason Smith, who heads up the Ways and Means Committee, said we can write the tax stuff. We've been working on it, and we can get it in one bill. So to me, it looks like it's going to be one bill, which to me is the more prudent way to go.
All right, Joe. Thanks so much for your time. As always, great to have you
Thank
here
you.
on Yahoo Finance. Keep it right here. We got much more of your market action ahead. You're watching Catalysts.
Prime Minister Justin Trudeau is expected to announce his resignation at a scheduled press conference. You can see live picture as we await those remarks outside of his home in Ottawa this morning. The news sending the Canadian loonie higher, hitting highs of the last 3 weeks this morning. For more on this, we bring in Mark McCormick. He's TD Securities Global Head of FX and EM Strategy. Mark, great to have you on here. So a currency jump off the back of this resignation reminds me of a stock jump after a CEO resignation. It's not something you want to see if you're the executive involved in the news, but what do we need to know about the currency impact here?
Well, I think an important part is to think about whether or not this is an idiosyncratic move in CAD or whether or not this is related to the broad dollar. I would put this in the latter camp. Largely, again, if you look at the price action on the day, CAD's not really an outperformer. It's just kind of moving in sync pretty much with the euro. So I think what we're seeing here is market positioning and valuations, which are very important short-term drivers of the currencies when we talk about weeks and days. Those tell us, based on the indicators that we track, that the dollar's just stretched right now. And you can see how sensitive the market was to the tariff news this morning. And I think this just feeds into that. The market's really long the US dollar. It's looking for excuses to pull back, maybe lighten up the trade a little bit. But there's nothing here that I think is idiosyncratic to the Canadian dollar or Canada. It just fits into a broader, what we call geo-macro theme, which is incumbents are losing. And the people are, essentially people are looking for a new change in direction in all forms of government, Canada, Germany, France. It's very consistent across the board.
Mark, is that what you would contribute some of the jump that we have seen in the loonie here today? And I guess how should investors be thinking about this? Should they be buying in today or at some point soon here, just given maybe some of the outperformance that this could be signaling for the months to come?
No, I'd say this is absolutely an opportunity to sell the Canadian dollar or the large bulk of other currencies that are moving higher today. Again, like what we're seeing is our positioning indicators are quite stretched. Our short-term valuation models are stretched. So again, this is an opportunity to buy the US dollar. We're probably going to see a strong NFP report on Friday. So I'd say, at least for the first half of the year, the strategy in FX, because last year was really dominated by a lot of mean reversion. It was very choppy. There wasn't really any macro themes to sink into. This year, as you saw from the fourth quarter handover to the first quarter now, I do think there are clear macro themes that people want to trade, whether it's equities, rates, central banks, carry. All these things are in favor of the dollar. So I would say this is an opportunity to buy the US dollar if it stumbles a little bit in the early part of the year. And again, I think we're going to see new highs in the dollar versus euro versus the Canadian dollar versus sterling versus Aussie versus China. So it's a broad-based move in the dollar.
I do want to end on China. There's some reporting that they are going to be willing to embrace the weakness of its own currency as a reaction function to tariffs and a hedge against the impact of those tariffs. Do you think that will be the case?
Yeah, I think the big thing is they don't want to front run this. They can play defensive. They have a ton of powder. They have a ton of savings. They can basically have a large current account surplus. They can boost the economy as needed, but there's no point in getting ahead of it. And I think it's actually counterproductive right now for China to let the currency go. And we've already tested 730. We've broken through that. I think some people are talking about 8, which I think is a little bit too extreme. I would say if things settle, it'd be around 750, depending on how strong the tariffs are. But I think a key point to think about from China's perspective is they want to maintain confidence in the currency because it maintains confidence in their overall economy. And China, over the last 5 years, has spent more time trading and using the renminbi with relationships in emerging markets, not with G10 countries. So I think a big part here is they will let it soften the blow, but we're not going to see a massive devaluation in the renminbi off the back of tariffs, in my opinion.
All right, Mark, we have to leave it there. Mark McCormick, thanks so much. Keep it right here. Coming up next, it's Wealth, dedicated to all of your personal finance needs. We'll see you tomorrow.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. On today's show, Navigating Your Portfolio, will discuss the stock and bond markets in 2025 and strategies that you can implement to help build your wealth. And President Biden signing legislation expanding Social Security benefits for millions of Americans. We'll discuss some of the biggest changes that are coming through. Plus, estate planning. As we kickstart 2025, it's time to review your financial planning. We'll talk to an advisor, a financial advisor, about the 3 documents that everyone must have in retirement. All that and much more coming up this hour. But first, we have some breaking news from the Federal Reserve. Yahoo Finance's Fed correspondent Jennifer Schonberger has the story. Hey, Jennifer.
Good morning, Brad. That's right. And a surprise announcement. Fed Vice Chair of Supervision Michael Barr has announced he will step down from the position of Vice Chair of Supervision effective February 28th, but will continue serving as a governor on the Federal Reserve Board of Governors. Barr saying in his statement, quote, "The risk of a dispute over the position could be a distraction from our mission. In the current environment, I've determined that I would be more effective in serving the American people from my role as governor." Barr, who has served as Vice Chair of Supervision since July 2022, has submitted his letter of resignation to President Biden. Now, Barr's resignation coming just ahead of President-elect Donald Trump officially taking office on January 20th. A longtime economic aide to the incoming president, Steve Moore, told me on Friday when I asked whether Barr could be replaced that was, quote, "something in the mix." Of course, Barr, very unpopular amongst Republicans, members of the banking community and banks, for having pushed much higher capital requirements as part of Basel III, a leftover piece of legislation that needed implementation following the financial crisis. Again, the breaking news here, Brad, that Vice Chair of Supervision Michael Barr will be stepping down from that position as of February 28th, but will remain on as a governor. Back to you.
Jennifer, thanks so much tracking that story and bringing us the latest. Appreciate it. Stocks climbing to start the week here, looking to recover from last week's losses. Joining me now, we've got Burns McKinney, who is the NFJ Investment Group Managing Director and Senior Portfolio Manager. Burns, good to have you back on the program with us. You're specifically watching value stocks, and you say now is the time for them to outshine growth stocks. Just define the thinking around value versus growth right now, even in this environment, and why you're expecting this type of performance.
For starters, you really do see an economic situation coming into the new year where, we have, GDP growth has been pretty close to 3%. Unemployment is pretty close to 4%, and inflation has now got a 2 handle on it. And so, that looks like somewhat of a Goldilocks type scenario. If that's the case, then investors should expect a continuation of the broadening of returns that we saw during much of the fourth quarter last year, up until the Fed, I think, had a little bit of a hawkish commentary in mid-December. So, typically a Goldilocks type scenario is good for value stocks. You also have just reversion to the mean working in your favor. If you look at the U.S. Value Index, it trades at roughly a 50% discount to the growth index. Typically, it would probably be about half of that type of discount. And so reversion to the mean also works in your favor as a value investor. And I think finally, the third key point is that interest rates, despite the fact the Fed is lowering rates, they should probably, the longer term, the 10-year bond yield may stay a little bit higher than it has been over the last 10 to 15 years, which is the type of thing that maybe should push investors into shorter duration financial instruments, which would mean away from some of the really the highest growth, the growth stocks, for which a lot of your value is coming from cash flows you expect in the distant future, into something for which you're getting a lot more of your cash flows today, and that tends to be value equities.
Okay, so when you think about this, the parameters, or at least the checklists that investors should be going down for the value equity portfolio play, what does that checklist look like?
Yeah, and looking for names in value, you definitely, you don't want to go bottom fishing. You want to look for quality. And so, probably the key things we look for is free cash flow, that pretty much cures all ills. Free cash flow means you can return capital to shareholders. It means you can support a dividend. It means you can, clean up balance sheets and pay down debt. Look for companies that are generating a lot of free cash flow. And, probably the second thing you look for as far as trying to go into quality value names is, the holy grail is pricing power. Look for companies that have some sort of sustainable competitive advantage that allows them to generate pricing power in an environment that might not be as inflationary as we've seen in recent years.
Burns, as you were mentioning the economy here, it kind of brought back the thought of what the economy is anticipated to do over the course of this year. And you're anticipating a slower but more sustainable economy, normalizing from some of the hot post-pandemic rebound that we'd seen 2021 to 2023 year. So as you're thinking through 2025, what does the calculus kind of lead you to believe we could see play out? And what does that mean for the Fed and how they could also influence in their decisions what markets might be trying to get ahead of as well and anticipating the Fed?
Well, again, I noted that the economic situation is certainly fairly comfortable right now insofar as that we don't see a recession in the next 6 to 12 months. But a lot of the near term and the forward-looking indicators show that the growth is slowing, and that's not necessarily a bad thing because it does lead to a more sustainable growth. The way I like to think, if I'm a marathon runner and I come out of the gates, blazing at a 6-minute mile, I'm gonna burn up and overheat about 3 miles, which is something that kind of is represented by inflation. But if you come out with something 8-9 minute mile, it's something that maybe you can sustain that for 26 miles. Then the key to that means that you can still see the consumer can remain strong. You can still see jobs remain solid, and you still have that growth without becoming overly inflationary. And that's the key. You noted the Fed because if we can actually sustain that momentum without having a relapse in inflation, then it would allow the Fed to stay on the sidelines and potentially continue to reduce rates at some point this year, which is really the tailwinds that investors are looking for. Stock valuations are a little bit rich, but the policy outlook is still pretty positive insofar as the central bank is still in cutting mode, and you never want to fight the Fed.
Yeah, look, you surely are spoken like a marathon runner. So we'll be looking for those splits just to see exactly what you're running yourself, Burns. But just lastly, while we have you here, want to get your picks as you're thinking through the plays that you've just outlined here on a sector basis. Who is best positioned to outperform this year?
Well, one of the first things that we look for as value investors is try to find something that's out of favor. Look for embrace headline risk. And when I think headline risk, the first thing that pops to mind is the healthcare sector. You do have it's a sector that lagged last year. You have a lot of investors worried specifically about the incoming administration, and perhaps the appointment of RFK Jr. might lead to threats to managed care or to some of the vaccine makers and some of the drug companies. But at the same time, what people are really overlooking is the fact that the new administration may also ease a lot of regulatory burdens. So you might actually not have the same degree of headwinds that investors are talking about. And this is a sector for which right now it trades at a discount to the market. You don't often get that. And you do have historically solid earnings growth. It's you can kind of have your cake and eat it too, whereby demographics tend to be defensive. But the healthcare sector, if you look at the longer term over the last 40 or 50 years, has actually grown earnings faster than any other sector. And so if you can get it at a discount, then that really is quality at a reasonable price. And so that's one place I think investors should maybe lean into some of that headline risk.
Burns, great to grab some time with you here. Appreciate it. We'll talk about the splits offline.
Sounds good.
Thanks.
Thank you.
The AI boom expected to continue in 2025, but it might look a little different. Yahoo Finance's Josh Lipton joins me now with more on how the AI trade could evolve this year. What are we anticipating?
That's right, Brad. So there is no theme we know investors have been more excited about than the mega AI trend. That enthusiasm helps explain the performance of the Magnificent Seven in 2024. Big tech names like Apple, Meta, Amazon, Tesla, Alphabet all enjoyed strong runs. The MAGS ETF, which tracks this group, it's up about 70% over the past 12 months. So how does that AI trade now evolve over 2025? Well, some analysts argue that yes, AI-related names have indeed enjoyed great runs, but they believe investors can stick with what has been working, such as the all-star performers like NVIDIA and Broadcom.
There's going to be continued momentum in the what we'll just call infrastructure play. So that's the networking stocks, Broadcom, Marvell, and obviously NVIDIA remains super well positioned going into 2025. I think everybody's confirming a whole host of demand for continued GPU growth for them. And then obviously everybody else that's in that cycle, right? So AMD as well, Intel.
Now, Beharon's enthusiasm in part is driven by the bet that those so-called hyperscalers, those giant cloud computing providers, are going to continue their chip buying spree in 2025. But in addition to hardware, Dan Ives over at Wedbush says to expect the broader software space to get in on the AI party as well. As he puts it, use cases, Ives says, are exploding. One of his favorite ways to play that trend, Palantir, which has already soared about 370% over the past 12 months. Now, some on the street are concerned about valuation after such a remarkable move like that, but Ives disagrees.
The transformational tech winners, if you just focus on valuation, you've missed all the transformational tech winners, from Apple to Meta to Google to Tesla and others. I believe, to me, it's the view, can they get to 10 billion in revenue? Can they get to $5 billion of free cash flow next, call it 3, 4, 5 years? Those are some of the numbers that we're talking about.
And finally, as our own Josh Schaefer reports, Goldman Sachs argues that the AI trade is going to evolve in the year ahead as well, moving into a basket of stocks it calls enabled revenues. In other words, companies that will benefit from the rollout and monetization of AI solutions, those companies that can use AI to drive sales but aren't actually selling things like AI chips to other companies. And this would include names like Adobe, MasterCard, and Salesforce. Brad, back to you.
All right, excellent stuff. A lot to track here. And it's kicking off some of the conversation at CES this week as well.
Exactly right.
We've got much more coming from there. Josh, thanks so much.
You got it.
Appreciate it. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Nippon Steel and U.S. Steel jointly filing lawsuits to maintain their planned merger after President Biden blocked the deal last week. The litigation involves two cases, one in the U.S. Court of Appeals for the District of Columbia, alleging that Biden and CFIUS's decision-making around the merger here, that is in question, and then the second in the U.S. District Court for the Western District of Pennsylvania against rival steelmaker Cleveland-Cliffs over its alleged actions to prevent other parties from acquiring U.S. steel. Next up here, we're also tracking Uber. Uber has entered into an accelerated share repurchase agreement with Bank of America to repurchase $1.5 billion worth of shares of Uber common stock. This is part of the previously announced $7 billion in buybacks. And finally here, we're also tracking AT&T, boosted to outperform from sector perform at RBC. The analyst citing stronger confidence in the company's growth and shareholder return profile versus its peers. Meanwhile, the analyst cut T-Mobile to sector perform, saying they see less favorable reward risk based on current valuation. The 30-year yield hit a 14-month high today. This is ahead of the U.S. government's $119 billion bond sale later this week. Here with a look at the role that bonds should play in your portfolio in 2025 is Cooper Howard, Schwab Center for Financial Research, fixed income strategist here. So what is the weighting, what is the percentage that you're recommending for bonds to play in the portfolio mix for investors?
You know, that's a great question, Brad, and one we oftentimes get from clients. And I don't think that there's an exact answer to it. I think really what it depends on is, why are you investing in fixed income to begin with? We think that there's really three primary reasons that we recommend fixed income to most of our clients, and that's income, capital preservation, and then diversification is the third reason. So we think that fixed income should play a role in most of our investors' portfolios, but how much is really going to depend on what your goals are, what you're looking for to get from your portfolio. Because at the end of the day, all that a bond is, all that fixed income securities are a contract between you, the investor, and the issuer of that security. So I think sometimes some clients can be confused about what fixed income is, how it should play a role in their portfolio. But for what we suggest, when we tell many of our clients, if they've purchased a CD in the past, that's very similar to purchasing a bond. You know what you're going to get, when you're going to get it, and who that issuer is coming from. So those are kind of the three primary reasons that we suggest investing in fixed income. And I think that it more boils down to who you are as an investor and what your goals are versus what an exact allocation is, just broadly speaking.
The moves in fixed income could also, of course, as always, hinge on what the Fed decides to do. And as of right now, it seems like they're signaling for at least two rate cuts this year is what they've put out into the market's mindset here. What is your best estimation for what could play out and the impact on fixed income?
You know, that is our estimation of what the Fed is going to do as well. So we do estimate that they are going to cut 2 times by 25 basis points each. But in terms of the outlook for 2025, I think that there's a lot of uncertainty, and that could filter into the fixed income markets in terms of a lot of volatility. And if you recently look at just the most recent dot plot, I think that a lot of that uncertainty is displayed in the most recent dot plot. So one Fed official, for example, projected no rate cuts this year, while another Fed official projected 125 basis points of rate cuts this year. So there's a wide dispersion about what Fed officials believe the ending rate for that Fed funds rate is going to be in 2025. But with the economy continuing to perform relatively well, hovering around 3%, unemployment continuing to hover around 4%, and then inflation not meeting the Fed's 2% target, I think the downside for additional rate cuts is going to be limited.
Okay, so all of this in mind, there may be some out there that are trying to figure out where lower rate rate issuers actually might play a role in their own portfolio as well. How are you evaluating this?
You know, when we look at lower rated issuers or kind of some of those more speculative rated issuers, what we generally suggest is start with the bulk of your portfolio into core bond holdings. Those are going to be treasuries, mortgage-backed securities, investment-grade corporate bonds, or potentially municipal bonds, depending on your tax bracket, and then add more aggressive risk or more aggressive income sectors. We suggest to most of our clients no more than 20% of your fixed income portfolios to those aggressive sectors. That's things like high yield corporate bonds, for example. And right now, we think that high yield corporate bonds, they can still play a role in an investment portfolio, but we're just a little cautious on the outlook going forward. And the primary reason is low spreads. So a spread, Brad, is just the additional yield that you receive for investing in that riskier issuer relative to, say, something like a US Treasury. Now, spreads are relatively low, so really what that means is that you're not getting too much additional compensation for taking on that added credit risk. So we, again, still think that high yield corporate bonds or those riskier issuers can play a role in a portfolio, but we're a little bit more cautious because if the economy does deteriorate, those low spreads don't give too much wiggle room in terms of the outlook going forward.
But it seems like what we were starting off the conversation with is that we're not seeing such a major deterioration to the point where it would be classified as a hard landing. So are we seeing from right now in the fixed income landscape that it's more of the traits of a perceived soft landing being carried out or being really enacted here by the Fed?
Yeah, I would agree with that. And one of your previous speakers, they kind of pointed to the outlook for a recession in the next 6 to 12 months is relatively low. I would agree with that. It looks like we are engineering kind of a soft landing where the Fed is coming in. And like I mentioned earlier, with the economy running near 3%, unemployment relatively low, we have seen the trend in inflation start to stall out. Overall, that paints the picture of a relatively healthy economy going forward. And again, that does limit the downside of what the Fed is going to do. But again, our expectation is that they are going to cut interest rates in 2025. And what that should mean is lower short-term yields. So the Fed has direct influence over the very short end of the yield curve and a little bit less of an influence over the longer portion of the yield curve. So we do think that the yield curve is going to steepen, meaning short-term yields are going to continue to move lower, while longer-term yields, it looks like they do have some potential upside from here.
Cooper, thanks so much for taking the time. Happy New Year to you.
Thank you, Brad.
Appreciate it. Coming up, we're breaking down President Biden's changes to Social Security benefits, plus the documents that everyone should have ready when estate planning. All that and much more coming up.
By signing this bill, we're extending Social Security benefits for millions of teachers, nurses, and other public employees and their spouses and survivors. That means an estimated average of $360 per month increase. That's a big deal.
That was President Biden as he signed the Social Security Fairness Act into law. Here's how to know if you or someone you know will be affected. The new law rescinds provisions from the windfall elimination provision and the government pension offset. Both of these laws limited the amount of Social Security payments for public sector employees who receive pensions or other public service retirement programs. The Congressional Research Office estimated that eliminating these provisions will raise payments for roughly 3 million recipients. The Congressional Budget Office estimated that the average household affected by the windfall elimination provision will see a monthly increase of as much as $360 per month by the end of December 2025. The office estimated that those affected by the government pension offset with living spouses will receive an additional $700 per month. For those with deceased spouses, the amount will increase an average of $1,190. These payments will be effective as of January 2024, which means the government will give those beneficiaries back pay. They will also be subject to cost of living increases. Well, according to LegalZoom, 56% of Americans believe that estate planning is important, but only 33% have documented their end-of-life plans. Our next guest is here to close some of those gaps for us. Joining me now, we've got Nicholas Yeomans, who is the CFP and financial advisor and president of Yeomans Consulting Group. Nick, great to have you here with us. Let's kick things off with just how critical estate planning is and the risks if you are not properly prepared.
Yeah, I think it comes down to really a sense of responsibility to our families and our loved ones. At the end of the day, I don't want courts or some attorneys involved in my affairs and making decisions where I could have made the decisions for myself and my family up front. So really, this is about being proactive and making our decisions today rather than someone making them for us in the future.
You say that there are 3 critical documents that everyone in retirement should have. What are they, and can you break them down for us?
Yeah, so everyone should have at least these 3 basic documents. Number 1, we all kind of know it, but at the end of the day, we need the will. And the will is basically a letter to probate court that says what your wishes are and who will carry those wishes out. Number 2 is the durable financial power of attorney. Most of middle America today, their biggest assets are their home and their retirement accounts. This document plays a critical role in controlling those documents if we're incapacitated. And then lastly would be our healthcare directives. Our healthcare directives would include like a living will or advanced healthcare planning directives. Like in the state of Georgia, we have the living will, healthcare power of attorney, and conservatorship guardianship all in one document. So in the event we're incapacitated, who can make those healthcare decisions for us? We have to have those 3 documents.
It's really interesting because a lot of people are potentially thinking about one of the other documents that is extremely important with the revocable living trust. What do people need to know about that?
Well, I always say it's an optional document, but let me say it's probably the document that is growing the most in popularity amongst Americans today. Number 1, if you're interested in maximum control of your affairs, privacy, and avoiding probate, it is a fantastic document. Now, it doesn't do a lot of the fancy things a lot of people think they do, like for asset protection and things like that. But when it does come to providing that protection from keeping your affairs private and avoiding probate, it's a great tool. I like to think about it like it's a plain vanilla trust with some sprinkles. And for most middle Americans, you should be asking yourself, does this document make sense for me?
It's really interesting. And I was, as many of us are, obsessed with everything that Warren Buffett is doing on his trading. More interestingly, in the 4th quarter of last year, we saw how he was setting up different inheritances for his kids as well. Now, we should remind folks that his kids are in, I believe, their late 60s, early 70s.
Yeah.
So it's not like they're going to go out and just have a splurge spend, but not only do they have some sort of ownership over it, but there also are different trustees that are assigned to each of them as well. How do people and families really need to go about making sure that if they're kind of giving a certain inheritance or passing things down to members of the family who might need assistance making decisions at some point, that there are additional people who are set up that are trusted by the family as well to make those decisions?
Man, you are bringing up such a critical piece of estate planning, and it's missed all the time. One family that does it well here in Atlanta is the Truett Cathy family. But communication is key. We have to take the time to have the family meetings, have the family gatherings. And you don't have to talk dollars and cents. You don't have to do that. What you can do is express your wishes, express who you think should be in charge of what, how they should control the assets, what your intentions are without all of the legalese. If you can do that, you're 90% ahead of the game. So family meetings and communication, critical, and I'm sure that's something Warren Buffett's done really well.
Yeah, absolutely. Nicholas, thanks so much for taking the time here with us today. Really appreciate it.
Yeah, thanks for having me.
Certainly. Coming up, your Yahoo Finance market update. We'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
It's time for Yahoo Finance's Market Minute. Stocks higher to start a packed week of trading. Investors await the start to earnings season, plus the December payrolls report out Friday. Chip stocks are some of the top trending tickers on Yahoo Finance today, rising after Nvidia partner Hana reported faster than expected revenue growth, boosted by demand for AI hardware supply. And SolarEdge shares surging around 20% today after announcing it will lay off 400 workers globally. This is the fourth time in 12 months the solar panel company has announced job cuts. Plus, EV maker Lucid reporting upbeat fourth quarter and full year sales, exceeding its guidance by producing over 9,000 units in 2024. The company will report its fourth quarter results on Tuesday, February 25th, after the bell. And that's your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session. Stay tuned to all of Yahoo Finance for your market news.
A report by the CFP, or Certified Financial Planner Board of Standards, reveals that 97% of Americans have at least one financial priority for 2025. Topping the list of goals, 42% looking to reduce debt, 21% looking to save for a major purchase, and 14% looking to plan for retirement. These goals all revolve around one key aspect of financial planning: budgeting. Here with more, we've got good friend of the show, Michaela Alaka, founder of Break Your Budget. Michaela, great to have you back on. So how should people be setting up their budget for the new year?
Thanks for having me. Yeah, the very first thing that you need to be doing is taking a financial snapshot. And the top of the year is the perfect time to do this. And it's an opportunity for you to really audit your different accounts, understand your paycheck deductions and your cash flow and how much money is flowing in, how much money is flowing out, and also get an idea of your monthly spend for the various categories of your budget. I like to follow what I call a zero-based 3-bucket budget, which sort of marries a few different budgeting methods into one, and it allocates every dollar of income that I earn towards either an essential expense, a financial goal, or a non-essential expense. And this really is the budgeting method I recommend you follow in 2025.
Okay, all right. I'll be real with you here, and perhaps some of our viewers struggle with this too. Once you have a budget, how do you stick to it? Because that's been the challenge.
Oh yeah, most people struggle with sticking to their budget, but my best tip for this is to set what I call a weekly money date. And this is something that you should make a meeting with yourself on your calendar, your work calendar. I like to do mine on Monday evenings at 5 o'clock when I'm wrapping up the day. And it's basically 10 minutes where you sit down and you track your numbers, you're updating your expenses, whether you do this manually in a spreadsheet or with whatever automated budgeting tool that you choose. And then you look at how you spend your money and you compare it to what your original budget was. And then if there are any discrepancies or any surprises or anything that didn't necessarily go to plan, take a moment and make some adjustments, because it's super, super normal for your budget to change, for your priorities to change, for things to come up. And I think what a lot of people struggle with is once one small thing goes awry, they completely throw their budget to the wind and they say, I'll do it again next month. But where you're missing is you should just make some small adjustments. You can make some tweaks and realign your spending, realign your budget, and that will really help with actually sticking to the original plan and reaching those goals.
So how can people avoid overspending?
Yeah, overspending is a big problem. Overconsumption in 2024 was a big problem as well. In the long term, the goal is to figure out what your spending values are. So what are the things that make you feel really good, and what are the areas or categories where you want to cut back on? In the immediate short term, to help you figure out what those spending values are, there are a couple of things that you can do. So first would be to start tracking your expenses, because when you track your expenses, you're drawing awareness to where your money is going and how you actually feel about it. Are there things you're spending your money on that you're super excited about? And then are there things that you're spending your money on that kind of make you feel gross or icky? The second thing you can do is create what I call an impulse list, which is just a list on the Notes app on your phone where if you're scrolling social media or you're out and about and you see something that you want, instead of acting on that impulse, you're just adding it to the list and you're curating a list of things that in the future, maybe when you reach a different goal, you can go out and purchase. And the last quick thing here is to set small, tangible, like reachable goals. So maybe every week your goal could be to have 2 or 3 no spend days, or every week the goal is to put $25 into your high yield savings account. Ultimately, your financial success is a result of your day-to-day actions. So take it one day at a time and make your goals digestible.
All right, what do you do when your budgeting goals ultimately tell you, I might need to make a little more. I might need to try to figure out another way to bring in more income here to balance out. How do you go about that calculus?
Absolutely. So, I mean, discovering that you need to make more money, I think, is a really integral step. And throughout 2025, you can make it a goal to increase your income in a few different ways. Personally, I think that 2025 is the year of the part-time job, and not in a way where you have to completely overextend yourself, but in a way where you can figure out different opportunities or different paths to explore your interests and hopefully increase your income at the same time. So that's one way. The second way is to figure out if you either need to get a raise or a promotion at work, or if you need to go find a new job. And giving yourself the leeway and the time to navigate that decision is ultimately what is going to indicate your success. Making changes to your income takes time, it takes thought. You have to do some careful planning, but recognizing you need to make more is the first step. So those are a few of the avenues that I would explore if making more money is on your goal list for the new year.
Michaela, thanks so much for taking the time here with us. A happy new year to you, and look forward to checking back in.
Thank you.
According to LendingTree, 36% of Americans took on holiday debt this season, an average of $1,181. That's up around 15% from 2023. If you're one of those people, we want to give you some useful tips to manage that debt. Here to help us, we've got Emily Irwin, Head of Advice for Wells Fargo. Emily, good to see you here. So if, unfortunately, everyone was trying to be in the holiday spirit, clearly here, 15% up versus 2023, you got a lot of givers, cheerful as they may be out there. Now we got some debt that we also need to pay down cheerfully. Where do you start?
Well, the first place to start, Brad, is really not to get overwhelmed by the fact that you have debt at this point. It would be completely natural and normal to live in the inertia of, I don't know what to do, and therefore I'm going to avoid this situation. Rather, what I encourage people to do is really lean into it. Lean into your finances and try to deeply understand, where am I starting from? 2, set tangible goals for your short-term debt, your long-term debt, and other recurring payments that you might have. And then 3, make a commitment to yourself right now. This is the month of resolutions. Make a commitment to yourself to have a strong balance sheet and either maintain or continue to build a strong credit score throughout the year.
So with that in mind, how can you go ahead and recognize how much you spent in 2024 and plan, dare I say, plan already for the 2025 holiday shopping season in advance?
I'm a planner. I'm already planning for 2025. So you need to start by getting organized. This can be as simple as taking all of your statements and spreading them out on your dining room table. You might want to start with a spreadsheet, or even in your mobile app. Wells Fargo has the LifeSync app, which is incredibly helpful for this type of management. And what you want to identify is, to whom do I owe money? That's the first step. Is it a credit card company? Is it a recurring payment? Is it an individual that you maybe shared an experience or gift with? 2, how much do I owe for that particular item or experience? 3, what is the due date or commitment that I've made to pay it by? And then 4, what's the applicable interest rate relating to it? And what you also want to do is not forget about the other side of the balance sheet, because while it's good to understand the debt, if you just stop there, again, you go back to that feeling of overwhelmed. What you need to understand is, what's the cash flow that's going to come in, whether it's through salary, bonuses, part-time gig work, or other income that you can generate in order to be able to support those needs and those debts that you have. And when is it going to come in?
How can people identify the best debt management strategy for themselves? We've heard about a lot of them: snowballing, avalanche, a lot of winter corollaries there. But how can somebody go through that mental practice and ultimately figure out, okay, this is going to be the best strategy for paying down debt right now?
This is a know yourself moment. You must know thyself. So if you're someone who the thought of paying 1 cent extra just makes your skin crawl, then you're probably going to want to think about the avalanche method. And that's something where, of course, you make all of your minimum payments on time, again, getting back to that building a strong credit score. And then any additional funds you have left over, you apply those to your highest interest rate principal debt. And you do that because that means that really in the long term, you're going to be paying less from a debt perspective. By contrast, if you're someone who says, I'm going to have a hard time maintaining my motivation to continue this throughout the year, I feel like this is just a crushing amount of responsibility that I have, then the snowball effect might be a better one for you. And that's where you make those minimum payments, again, on time, and then any additional funds that you have, you go ahead and you start quickly paying off your lowest principal debt. And that way you really move that off your balance sheet and you have that sense of accomplishment immediately.
Emily Irwin, thank you so much for taking the time here with us today. Some very actionable tips for our viewers out there and me.
Thank you.
Coming up, how do you boost your credit score in 2025? I talked to an expert from Experian next on Wealth. A programming note. In this week's episode of Financial Freestyle with Ross Mack, Matt Garland, MG, the mortgage guy, breaks down why 20% down payments on a home aren't always the best option. Let's listen.
If you're buying a primary residence, you don't have to put down 20%, right? And I'm a fan of OPM when it comes to this, other people's money, meaning I'd rather use the bank's money and finance as much as I possibly can on this property so that way I can use my capital for other things and other investments so I can make money. Now, you only want to do this if you can afford to play this game, right? We're putting less than, 20% down if you can afford it. Right, but some of the programs, FHA 3.5%, you have knocker loans out there. You can do 100% financing.
New episodes of Financial Freestyle air Mondays, 12 p.m. Eastern Time. Catch them on Yahoo Finance or wherever you get your podcasts. A new year could mean a new credit score for those struggling to stay on track. If you have a score below 670, you may want to listen to the tips from our next guest. Joining me now, we've got Rod Griffin, the Senior Director of Public Education and Advocacy at Experian. Rod, Happy New Year to you. Thank you so much for hopping on. Give us the 3 keys to improving our credit scores in 2025.
So Happy New Year, Brad. Thanks for having me. And 3 keys. People are looking for a quick fix. There really isn't one. You have to do, as you said, basically 3 things. You have to pay your bills on time every single time, number 1. If you've fallen behind, catch up if you can. And then make sure that you are repaying your credit card bills, reducing your credit card debt. I'll add a 4th, you have a plan. So, holidays just gone by, I always tell people, be like Santa Claus, have a list, check it twice. When you're gift shopping, same thing applies during the new year. Have a list, check it twice, and reduce your spending, reduce those impulse buys. So maybe a few more than 3 tips.
If someone is unable to make payments on time, what are their options?
Yeah, several things. 1, notify your lender. Make sure that they know that you may be having some difficulty. They have plans in many cases that can help you with those payments. They may be able to defer or forbear your payments, work with you on a repayment plan that can reduce those costs and help you get there. They want to get paid just like you want to pay them.
Yeah, true. What about utilization rate? Is there a sweet spot for utilization rate to have on your credit cards to keep your score in check?
Yeah, 0. That's the ideal, of course. But what we have seen for many years is that utilization rates or balance to limit ratios on your credit cards that are less than 10% are ideal. We often hear about that 30% number. That's really a maximum. It's not a goal or a target. When you reach 30% utilization on credit cards, the risk of default begins to accelerate rapidly, and your scores will fall rapidly as well. So the lower, the better. If you can pay down your credit card debts, pay the balance in full each month, that's the ideal, because if you don't pay the balance in full each month, all you're going to do is pay the interest on the balance that's remaining.
Rod, it's a new year. You got some new resolutions really knocking around out there. And one of them for some consumers might be closing out a credit card. But does closing a credit card really hurt your credit score? And if so, why?
It can a little bit in most cases, but that might be just fine. When you close a credit card, you lose the available credit limit on that account. And as a result, your utilization rate based on the balances with your other cards goes up. That causes your scores to dip. Typically, that results in a change for about 3 or 4 months, maybe if that long, because it becomes clear you didn't take on a lot of new debt, but rather you've closed an account. That's a positive thing. Scores will rebound. So if you're planning to close an account, I wouldn't do it if you're planning to make a major credit purchase in, say, the next 3 to 6 months. If you're not, might be okay. Your scores will probably bounce back up, assuming that there are no other negative changes in your credit history.
And then while we have you here, we got to talk about fraud here. Fraud could be harmful to credit as well. How can we avoid identity theft and fraud this year? And if you are a target, how can you go about making sure that that doesn't hit your score because of something that happened to you, but wasn't necessarily because of a byproduct of your spending habits or you paying back something?
Sure. 1, check your credit report. You can get a credit report once a week for free at annualcreditreport.com from each of the 3 credit reporting companies. I would also recommend that you subscribe to a monitoring service. Many times they're free. Experian has a free monitoring service. We'll give you a free credit report and a free credit score and the risk factors that go with it. If there's any changes to that report, we'll alert you. That lets you respond right away. So be sure that you're proactive in checking your credit histories. That can be a tip-off. One of the first places people often find evidence of fraud. Lets you respond quickly. That's really key. You can, if you find evidence of fraud, add an initial security alert at Experian.com/fraud. We'll notify the other bureaus. That will add some protection for you, and then go through some additional steps if you need to. From there, it's about being proactive in the way you manage your information. Some people buy a shredder. They're cheap. And actually, identity thieves still love to go through people's trash. That dumpster diving is still one of their favorite ways to get information. So shred any paper that goes out with your information on it. That's going to help. And be careful about what you share, where you share it when you're online as well. That can be really critical.
Rod, some really valuable tips. Appreciate you joining us here today. Thank you.
Thank you so much. Happy New Year.
Happy New Year. The latest consumer price index, CPI, shows Americans are still being hit with higher food prices at the grocery store and at restaurants. Ricky Volpe, who is the former USDA economist, shared his thoughts on whether it's more affordable to cook at home or eat out.
It is still the case that it is cheaper to purchase food and prepare it and consume it at home. It is not the case that eating away from home has become cheaper than eating at home. In fact, it's quite the opposite. And food price inflation for restaurant foods, even fast food, is still way above normal.
But there is some good news for people who like to dine out, because the Golden Arches, McDonald's, is introducing a new McValue menu starting January 7th. Our own Brooke DePalma has the details on this. Brooke, this is McDonald's first national value menu since 2018. Color me surprised. What should consumers and investors expect here?
McDonald's here is really looking for a fresh start with, like you said, this first national value platform in nearly 6 years. After a year of lackluster sales growth, McDonald's also got hit with that E. coli outbreak and largely had to face this value perception that consumers had. Do I dine out to save money, or do I simply cook at home? And so all U.S. locations of McDonald's will be getting this McValue platform starting Tuesday, January 7th to kick off the year. It includes multi-facets to this McValue platform. First, starting with that $5 meal deal that McDonald's introduced last summer. In addition to that, we're going to be getting this new buy one, add one. So consumers can buy something and then add something for $1. In addition to that, franchisee operators will also be getting local deals, as well as these in-app exclusives. Now, analysts that I've spoken to said that this menu allows more optionality that we've had compared to previous national value platforms. For example, that buy one, get one for $1 allows a franchisee to set that price of that buy one. And in addition to that, we also, with this $5 meal deal, that has the potential opportunity to be increased, say, over time, if it does well.
Do you think we'll see other fast food chains introduce more value options?
Absolutely. 2025 will be an ongoing continuation of what we saw in 2024, this idea of affordability and value really driving consumers' decision. Now, this could be a good news, say increased guest count, but also it could be a hit to margins overall for restaurants. But McDonald's really the leader here. When McDonald's does something, analysts saying that others follow, sort of a game of follow the leader, if you want to call it that. So we're taking a look at Wendy's over time, Jack in the Box, Burger King, to see if they introduce more value meals in order to compete with this. But one person saying that this is not good for the entire industry. We know that discounts and value does end up hitting profitability.
All right, Brooke, we got to leave things there. Whoever has the best tater tots, they'll probably get my buck.
Okay,
that's it for Wealth, everyone. I'm Brad Smith. Thanks so much for watching. Stay tuned for Market Domination coming up 3 p.m. Eastern Time. You don't want to miss it.